about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Quiet morning so far. Equities just a little bit higher. Bond yields just a little bit lower. Equity futures on the S&P up by 0.25%. Bond yields down a single basis point. A break of 420 again, 419.80. Under surveillance this morning, Trump 2.0 haunting global leaders.
Across the board, indiscriminate tariffs. They are going to have 4 predictable consequences. Number 1, global retaliation. Number 2, it's a regressive tax on the most vulnerable segments of society. Number 3, it compresses profit margins for any business that imports components. And number 4 would isolate America on the world stage. There's a role for targeted tariffs, but tariffs alone are not a path to prosperity.
So here's the latest. The former president's potential return to the White House looming large as the world's financial leaders gather in Washington. Officials at the IMF's annual meeting zeroing in on one issue, his proposed tariffs on China and the rest of the world. Lisa's back with us from Washington, D.C. Lisa, give us an idea of the difference between what these leaders are saying publicly and what they're saying privately behind closed doors.
I'm kind of laughing to myself because that's exactly what I was going to start with. Publicly, they say, oh, we don't know what the outcome is going to be. How can we even come up with parameters for what it could look like? And in private, they're saying our inflation's going to rise dramatically. We potentially could see suppressed growth. We're going to have to totally rearrange our entire financial structure. We're going to have to figure out who our friends are. It's a completely different type of tone that really screams of deep concern that this could be a paradigm shift, John, potentially going forward.
Lisa, I saw your interview yesterday with Geeta Gopinath, and she was talking about that what kind of policies come out of the rest of the world depends on important elections without naming which ones, obviously the United States. So what kind of policies are some of these other countries thinking if we get potentially Trump back in the White House?
Well, there's concern about tariffs and what that does. There's concern about whether Trump could pull out of the IMF and some of these major organizations that ascribe to a free trade and some of the traditional structures of the financial system. At the same time, it's unclear. And that's what they all say. They don't know what is going to get thrown at them. And one of the big questions is how much is just simply the uncertainty have a whole drag on economic activity ahead of what those proposals could be, even after, say, if Donald Trump is elected. I want to bring in someone who knows vastly more than I do about this, our first Deputy Managing Director of Global Economy. That is Enda Curran. I love the titles here, Enda. We really appreciate you being here, and you've been covering the IMF meetings, and you've also been covering the IF meetings. And I would ask John's question to you, who could probably answer it a lot better than I am. How different is the public rhetoric and the private rhetoric?
So no one's mentioning the name, but all the focus here is on Donald Trump in particular, because the spillover for the global economy is his very hawkish rhetoric on trade policies, tariffs, protectionism, industrial policy, and the like. So a lot of the officials that we have spoken to are worried about what it will mean for investment in their country, what will it mean for supply lines and production and manufacturing around the world, how serious will Mr. Trump be if he was re-elected in terms of what he's talking about with tariffs, and how would trading partners around the world respond. So a lot of concern and worry here about the prospects for a renewed round of trade tensions if Mr. Trump is elected.
How different is the tone right now, both at the IMF and the IIF, the International Institute of Finance, considering that a lot of the global financial leaders are talking about the need for deregulation, the need for less public interference in what they do?
Yeah. Slightly different crowd, different messages. The public official sector, people here at the IMF are worried about spillover to growth and trade and what it means for economies. Of course, the banking crowd at the IIF, more of a hint there that what's better for markets, what's better for their business in the short term, and of course, which candidate will cut regulations more for them. Again, everyone's being very careful here. It's polite society. No one's endorsing any candidate or naming names, but it's clear in the tone of the conversations, you know, who's worried more about what.
Yeah, it comes at a time, and this is the reason why I bring this up. On one hand, at the IMF, you have people worried about Donald Trump coming in and getting rid of some of the old order. At the IIF, a lot of people are decrying overregulation that is causing a real stymieing of global business. I think about yesterday's deal that the judge said would be blocked, the Coach and Tapestry deal, the Tapestry and Capri, and a question about what can get done. That was something that John and Anne-Marie were talking about earlier. How much was that a main focus over at the IIF across town in Washington, D.C.?
Well, banking regulation is a focus among the bankers in town here. Obviously, they don't want extra regulation. They want to push back at it at every opportunity they can. So they, of course, are looking at which candidate might be better for their side of business. But I think the bigger picture, I must say, listening to people on all sides of this, the bankers or the official sector people here, is there's still a degree of uncertainty, unknown, just how will the election play out, and then of course how will Congress go, and that will dictate where policy goes. So, you know, they all have their favourites in this, they all have their favourite policy picks in this, but there are also a considerable degree of uncertainty as to what's going to happen.
The other aspect of this that I find fascinating is, on one hand, you have people in Washington who are decrying the debt load of the United States, who are decrying the fickle potential policies, the unknowns coming out of the world's biggest economy. On the other side, you ask people, where do you want to invest? The United States. Where is the sort of growth engine of the world? The United States. How conflicted are those two messages?
It is conflicting. There's no doubt, and to be clear, there is focus on debt during these talks. There is a lot of scrutiny on where is the fiscal trajectory going in the US, but at the same time, this remains a magnet for investment. All of the people I've spoken to are saying the US remains wide open for business. It's attractive. It's got a high yield on offer. It's got a flexible workforce. That the sort of this goodwill towards the US economy is certainly a recurring theme of these meetings. But again, it goes back to this point I'm making, Lisa, is that there's also that degree of uncertainty. No one quite knows what's going to happen after November 5. You know, who's going to win and how will Congress go? That's key for policy.
A lot of robust conversations. Enda Kurd, always wonderful to speak with you. And John, that definitely is the tension here. This sort of fear about the United States and, frankly, the envy of the United States given its economic situation.
Lisa, thank you. Alongside Enda Kurd, just spot on. This is the theme we've been sort of looking at over the last few weeks. If you export to America, you might have a problem. You might have a big problem. But if you invest in America, you might be very well rewarded for that.
Well, where they ended that conversation reminds me of what Christian Lindner, the German finance minister, said yesterday. He said every kind of trade conflict harms both sides. Does it? It's Europe that's going to get hit on both ends. And that's what Gilles Moët said to us. It's the fact that if Donald Trump comes back, 10% around the United States for those exports for Europe is going to hurt. But then the fact that where else is China going to go if the United States puts 60% up? More dumping on the European market.
Europe's got to eat it. Equity futures right now, up 1/4% on the S&P. Up next on the programme, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge, John Dugan of Citigroup, Neil Dutta of Renmac, and Jason Thomas of Carlisle. The second hour of Bloomberg Surveillance, up next.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto.
Like, let's say somebody is an, Uber or Lyft driver today, where they can actually sort of manage a fleet of cars, and sort of manage, I don't know, 10, 20 cars, and just sort of, take care of them like a shepherd tends their flock. You have a little flock of cars, and you're the shepherd, and you take care of your flock of cars. I think that would be pretty cool. And I think it's going to be a glorious future. It's going to be really something special. So, yes, good, all excellent questions. So we do expect actually to start fully autonomous, unsupervised FSD in Texas and California next year. And that's obviously, that's with the Model 3 and Model Y. And then we expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with timeframes, but in 2026. So, yeah, before 2027, let me put it that way. And we'll make this vehicle in very high volume, and but well before that, you will experience a robotic taxi via the Model 3 and Model Y program, and Model S and X too. But your 3 and Y will achieve unsupervised full self-driving with permission in wherever regulators essentially approve it in the U.S. and then to follow in outside the U.S. So, and it's Cybertruck too. Yes, of course. Sorry, I don't want to forget. Yes. All our cars, basically, all cars that we make. So.
Dedicated to tech, right in the middle of the trading action. Every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
When the Fed turns dovish, financial conditions begin to ease. This has been a very strong tailwind just in the last few weeks.
The economy is proving to be much more resilient, suggesting that they really aren't as restrictive.
They're being restricted by keeping rates this high in the curve inverted.
We're just waiting for this very small number of data points that still seem to matter.
When folks say, you know, there are recessionary signals, they are right. When they say the economy is resilient, they are also right.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, the second hour of Bloomberg Surveillance starts right now with the market board so far this morning just a little bit quieter. Let's start with equities. Your scores look like this on the S&P 500, firmer by 0.2%. Still on course for a week of losses and snapping a 6-week winning streak on the S&P 500. On the Nasdaq 100 up by 0.2%, on a Russell up by a third. Speaking of quiet, some welcome quiet for some of you I know in the bond market. The 2-year, 10-year and 30-year just a little firmer. Yields a bit lower. We're down a basis point. The 10-year 4.1960, the 2-year 4.06%. This time next week, this bond market focusing on one thing. It's the payrolls report. The median estimate in our survey right now is 120. The low is 70. It comes from Wolf Research. The high is 164. That high comes from RBC.
But Bloomberg Industries is potentially talking about the fact that our economics team, maybe we get a negative print, negative 10K jobs change. Why? No one can really assess what is happening right now. You have Boeing strikes. That deal didn't get done. 33,000 workers out in Seattle are still on the picket line. On top of that, what is the hurricane impact? And then you see the numbers yesterday of the jobless claims. It feels like there really wasn't a hurricane impact. How do you read this jobs market? That's going to be a very difficult one.
With great difficulty. So let's take the claims number yesterday. You're right to identify that as a key point. Jobless claims back to pre-hurricane levels. So what's the risk for next week? For a lower print, bar's already come down. The estimate's 120. Jim Bianco of Bianco Research on this program saying the risk for next week is a stronger number.
What if we get similar to what we saw in September? This blowout potential higher report. What is the line in the sand for the Fed to say, actually, maybe we will go on pause? What if they get a huge number plus no decision from the presidential election when they meet 2 days after?
We keep going back to the calendar. November 1 for the payrolls report, November 5th for the election, November 7th for a Federal Reserve decision. Coming up this hour, your next 60 minutes looks like this. We'll catch up with Mohammed Al-Aaron of Queen's College, Cambridge on rising gold prices. Lisa will catch up with John Dugan of Citigroup on the banking sector under a new presidency. And Neil Dusser of Renmac expecting weakness going into 2025. We begin this hour with bonds rebounding, the 10-year yield inching down from 3-month highs. This as gold falls slightly from all-time highs. Mohammed Al-Aaron of Queen's College, Cambridge writing the following. What has been happening to the gold price is not just unusual in terms of traditional economic and financial influences. It also goes beyond strict geopolitical influences to capture a broader phenomenon, which is building secular momentum. Mohammed joins us now for more. Mohammed, welcome to the program, sir. Always looking forward to rounding out the week with you. This got a lot of attention in the Financial Times this week. Just take it from the top for us. What are you trying to get people to pay attention to? Not just why the move is higher, but what is behind it and how long this has been building for.
And thanks for having me, John. Look, gold is up 32% year to date. That's compared to 22% for the S&P. When we try to relate the moves in gold this year to the traditional economic and financial variables, interest rates, inflation, the dollar, you know them, the relationships have broken down. It has been a very sort of linear move up, and it's something that's continuing for a while now. Then you ask the question, who's buying? And you start getting the answer that what is happening to gold goes well beyond economics and finance, goes well beyond the fluctuation in geopolitics. There's something secular going on, and that has two elements. One is slow diversification away from the dollar in the reserves of central banks around the world. And the other one is a slow diversification away from the dollar payment system. Now, the good news for the US is both are slow because you cannot replace something with nothing. People are still building alternatives. The bad news is that the momentum is building up. So this is something that people have to take seriously in the US if they want to maintain the influence that the US has globally.
Mohammed, do you think this is a fairly recent trend or something that's been building for a number of years, maybe even decades?
It's multi-year, but it's been accelerated recently by two events. So it's multi-year because there has been some questioning about the US being a good steward of the global system. The global financial crisis was the first shock. The weaponization of trade and investment was a second shock. The way the US treated inflation was a third shock. So there's been questions built, and we've seen little pipes being institutions, payments system. But then there's been two more frequent, more recent events that have accelerated that. One is Russia being able to continue to trade and grow while being kicked out of SWIFT. That has gotten a lot of people paying attention. How did Russia do this? And of course, the answer is they built a very clunky system that involves 4 other countries, but it works. And they avoid the dollar completely. That's first of all. Second development is what's been happening in the Middle East, where the majority of countries around the world have viewed the US as an inconsistent backer of human rights and an inconsistent backer of international law. So you've had those two recent developments that have accelerated something that's been in play for a while.
Mohammed, I'm glad you mentioned what's going on with Russia. John and I spoke to Dalip Singh yesterday, Biden's Deputy National Security Advisor for International Economics, and we asked him this. What do you say to those that say sanctions don't work? They just create new markets. And his response is, well, what's your alternative? You have to do something. I guess the question is, what is the alternative?
So that's a really hard question, Anne-Marie. There is no easy alternative. I think if you look back, those who imposed those sanctions now wish they had gone far further straight away. That this slow augmentation of sanction has given Russia enormous time to build alternative systems. That if you're serious about sanctions, then you should be willing to absorb the cost of sanctions to you. And that's something that neither Europe nor the US was willing to do initially. They were very worried about the blowback in terms of oil prices in particular. But looking back now, I suspect that they wish that they had gone further initially.
Well, that's part of the problem when a lot of critics of this White House is why have a price cap, just sanction the actual oil and gas and cut off the funds that Putin is using to continue to wage this war. Putin is hosting the BRICS summit. He says it's now a multipolar world is emerging. Do you agree?
So certainly the BRICS summit is involving more countries and more heads of state. But to jump from there to say multipolar world, that's way too far. It is still at a very, very early stage. It's going to be very hard to get them to unite around certain issues. So we should pay attention. I think if you want to worry about a multipolar world, you worry about China. China is creating institutions. The U.S. is not part of the Asian Infrastructure Investment Bank, and that institution is growing and is collaborating with the World Bank. China is building little pipes around the system, 50 bilateral payments agreement with other countries that completely exclude the dollar. So if you're looking at the alternative architecture, pay attention to China. Now, I want to stress there is no other currency to replace the dollar at the core of the system, and there's no other payment system to replace the dollar payment system, but you can build pipes around it, and that's what starts fragmenting the system.
And as we know, China has been buying a lot of gold. So, Mohammed, let's bring it home a little bit. We've talked a lot about international forces. Let's talk about domestic ones. The U.S. deficit. Now, if you look at traditional financial indicators like the Treasury market and foreign exchange, Treasuries, we're seeing higher yields, but what we're not seeing in the FX market is a weaker dollar. We're not seeing a weaker dollar, and some people might suggest that that's not a real worry about the deficit then, no real sign of a buyer's strike away from dollar-denominated assets. You're not seeing the euro, the yen, or the Chinese yuan much stronger off the back of this. Now, some people might push back and go back to your story, Mohammed, and say, actually, you are seeing the dollar depreciate. You're seeing it depreciate against gold. Mohammed, can you share your thoughts with us about whether we are starting to see some concerns creep in about the U.S. deficit into financial markets?
So first, let's start with currencies. Currencies are relative prices. So you would not pick up concern about the U.S. deficit because other countries have their own debt and deficit problems. You know, I go back to this notion, the U.S. is the cleanest dirty shirt. So you will not pick up in the currency, in the relative price. So you have to look at an absolute price, and that's why people compare the dollar to gold. Gold is a store of value. Gold is not really a currency or a unit of account. It is a store of value. And people look at that and say, well, relative to gold, the dollar is depreciating. Now, why is it doing this? I talk a little bit about that, but it's not just the impact of the debt. I mean, the impact of the debt is making people wonder about how, over the very long term, I want to stress, the creditworthiness of the U.S. Bond yield levels are now being impacted, John, by four things, and you pick. No one has been able to tell what it is. One is U.S. economic exceptionalism. We are simply growing better. Look at the recent IMF revisions. U.S. up in terms of growth rate. Second thing is the recalibration, although I hate that word, the recalibration of expectations for the Fed. And a question mark as to was 50 basis points in October a mistake. The third issue is the debt. And the fourth issue has to do with the overall sort of confidence in there. No one's been able to tell me, John, with any degree of confidence, the relative weight of the four. So yes, debt may be an issue, but I'm not sure how big it is.
Mohammed, you forgot one provision, one topic, the U.S. presidential election. Is that impacting gold right now? Is that impacting bond yields right now?
So certain people feel it's impacting bond yields, and they throw it in there. And then you ask, how is it impacting bond yields exactly? Is it the tariffs? Is it industrial policy? What exactly is playing out in there? And then it's hard to answer. So I'll add it, if you want, to the list, but I suspect that the coefficient on that is not as high as the coefficient on some other things, particularly U.S. economic exceptionalism and Fed policy.
Mohammed, just a final word, Yankees or Dodgers? That's all we want to know.
Anne-Marie's sitting right next to you, and she has a wonderful New York Yankees cup on there. I told her in an earlier thing that for the first time ever, I may be thinking of abandoning the National League.
Mohammed Al-Arian, big call there. Mohammed of Queen's College, Cambridge. That was the bigger call. Never mind the gold price.
I'm just curious if he's paying up for those tickets.
This was like you and the shopping channel there.
Yeah.
Look, it's QVC. It's perfect. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Morgan Stanley has named CEO Ted Pick as its next chairman of the board. Pick was expected to be named for the role after his predecessor, James Gorman, stepped down, or announced that he would step down, rather, at the end of the year. Pick took over as CEO at the start of this year. Under Pick, shares have climbed nearly 28%. Donald Trump is expected to appear on Joe Rogan's podcast later today. Political reporting that the interview will be held at Rogan's Austin, Texas studio. Rogan's podcast is the nation's most popular. It has over 14 million followers on Spotify. Trump has never appeared on the show. Meanwhile, Rogan's commentary on the former president has ranged from critical to friendly over the last few years. A spokesperson for the Harris campaign confirmed that the vice president will not be appearing on the Rogan podcast. 4 astronauts returned to Earth this morning after a nearly 8-month stay at the International Space Station. Their stay was extended by Boeing's capsule trouble and Hurricane Milton. A SpaceX capsule carried the crew parachuting before dawn into the Gulf of Mexico just off the Florida coast. 2 Boeing Starliner test pilots, though, are still stuck in space, where their 8-day trip was extended to 8 months. They are set to return in February. That's your Bloomberg Brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, Wall Street facing down U.S. election risk.
When you add on regulatory potential arbitrage, and that may or may not be a consequence of protectionism or is another form of protectionism, then you easily go into the debate of how to protect your financial markets.
The latest from Citi, up next on the program, live from New York City this morning. Good morning.
We spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Equity futures on the S&P 500 up here by 0.2%. Bond yields a little bit lower, down 2 basis points, 419.40, even with crude a bit higher, up by 0.8%, $70.75. Under surveillance this morning, Wall Street facing down election risk.
You look at how capital can move across different jurisdictions in a way that can create value and can help address many of the topics that are affecting our economies and our societies, then you start to see really the cost. When you add on regulatory potential arbitrage, and that may or may not be a consequence of protectionism or is another form of protectionism, then you easily go into the debate of how to protect your financial markets.
So here's the latest. Bank stocks hitting levels not seen since 2023 after a better-than-expected earnings season, the US election and an overhaul in bank regulations still causing some uncertainty for traders. But Citigroup Chair John Dugan saying he doesn't expect the revamped bank capital rules to be finalized until after the inauguration of the next president. Lisa joins us now from Washington with a special guest. Hey, Lisa.
Hey, John. Yes, indeed. It is John Dugan in the flesh. He is the chair of Citigroup, has joined the board since 2018, and has really seen a whole host of cycles after formerly being the OCC chief during the financial crisis. John, thank you so much for being with us. I want to start with this idea that there just are so many unknowns, whether it's regulation, whether it's trade policy, whether it's tariffs. How much are people in the banking industry somewhat paralyzed?
I don't think so. And I'll give you a good example. Our trading business, this can be a very good time of the year because there's volatility as there's uncertainty. And when there's volatility, that's good for our markets business. On the other hand, there are other businesses, if you're an investment banker, these 2 weeks leading up to the election, they're not likely to be active in the deal space. But this too shall pass, and people are navigating it and just looking ahead to see how they will navigate it.
One of the levels of uncertainty is just how bifurcated are the scenarios depending on whether Kamala Harris wins or whether Donald Trump wins. And if you could just bring us into a window of Citigroup's thinking of what the parameters are. You know, what's the sort of base case in the extreme case if Kamala Harris gets into office, and what about with Donald Trump?
So I think if Kamala Harris gets into office, we can expect more of a continuation of the policies that we've seen under Joe Biden, although it could be that it would be a little bit more business-friendly because we may have a Republican Senate, and that's the conventional wisdom now, and that means nominations in order to get through the Senate are going to have to be a little bit more negotiation with the Republicans, and that could change the makeup of the people who get through. So that's a more modest change, I think. On the other hand, if Donald Trump wins the election, there will be very significant changes to personnel, and that could change the whole nature of who our regulators are and how we operate. And that's an unknown, but it will be very different. It's a little difficult to plan for because we don't know exactly what that would mean.
Typically, less regulation, a lot of people think of as a positive for banks, that allows them to be more profitable. Citi is in a unique position because you are a global bank that really does benefit from trade and from the free flow of cash between different economies. How would Citigroup really rearrange if free trade is impeded, if you do get a real restructuring with tariffs and other protectionist measures?
Yeah, I think the way we look at it is, yes, it is true that globalization has benefited Citi because we're in 100 countries on the ground and do business in another 50. But the fact of the matter is, if people change from being in a lot of countries to being in somewhat fewer countries and changing and figuring out how to change those supply chains, we are in a very good position to assist people as they make those changes, because we have people on the ground in the places they're going to and the places they're coming from. And so we see that as business opportunities. That's the kind of thing we navigate all the time.
How much do you see Donald Trump really differing in terms of regulation when it comes to antitrust and some of the banking capital oversights, especially given some of the commentary that we've heard from his vice presidential running mate with respect to the current FTC leadership? And I ask this because I have to be honest, I was with a banker when that news dropped about Capri and Tapestry, and he was just beside himself. He couldn't believe that this was sort of the framework with affordable luxury handbags. I'm just wondering if that is sort of the expected norm going forward for you.
I think the way I would put it, I think there's an expectation that there will be more transactions and more deals that will get done, and that's a positive thing for our deal business. And so we would look forward to that. If it doesn't happen that way, we will not navigate the other side.
So 10 days ago, Citigroup came out with earnings, and it showed that it was seeing strength in a lot of the different 5 business lines as it streamlined things. It was a beat across the board, really good. Shares popped, and then Jane Fraser got on the phone and with analysts, and someone asked her about a possible asset cap, about whether potentially there could be some implementation. And she hesitated, and the shares plunged. And then she clarified, no, there is no asset cap, and there is not any plans for any kind of asset cap. And yet the shares still fell on that day. How frustrating was that for you?
Very frustrating, because she did clarify it within minutes of the uncertainty around it. And what she said is absolutely clear. There is no asset cap. We don't have an expectation for an asset cap. And our business performance was really very strong in the third quarter. So it's a bit of a mystery, and yes, it was frustrating.
How does Citigroup get out from under this regulatory cloud that seems to be sort of increasing a lot of skepticism in investors?
We have to make progress slowly and surely every quarter and making proof points of doing what we say we're going to do business-wise. So, for example, in the third quarter, as we had committed to, our revenues were up on 3% on an ex-divestiture basis. Our expenses were down 2%, operating leverage increasing in each of those 5 business lines. Those are the kinds of things that we got to keep doing to show that we're making progress towards our medium-term targets of an 11 to 12% return on tangible common equity.
Where is Citigroup in this transition to streamlining these 5 businesses right now?
I think we're in a very good, very exciting place. I think the board is quite excited about how the company is doing as measured by those 5 businesses, which, by the way, is much more transparent now. You can see it much more. There's a there's a removal of a layer between the board and Jane and those businesses. They're much more accountable because it's so transparent about how they're doing it. And we saw some very exciting things in the third quarter. I'll mention 3 of them. The Apollo credit deal, $25 billion deal, very innovative. We had the largest deal transaction with the Mars acquisition of Kellanova that was announced, where we were the sole advisor. And we had a very exciting deal with MasterCard to tap into their international debit network. And these are the kinds of things where Citi really is getting on its front foot in each of these businesses.
How much are you thinking about another deal like the Apollo one?
Well, it's early days on Apollo. I think, as I said, we're quite excited. We think that really gives us the ability to offer a whole range of things to clients that we wouldn't otherwise be able to do, and that's the important piece. Let us see how it goes before we go down another path.
As a global bank, are you still sort of emphasizing that global reach at a time where everyone's looking at the U.S. and saying, it looks pretty good over there?
Still a lot of business going on all over the world. We're there to help people in their be the preeminent bank for companies with cross-border needs. They may have different cross-borders that they're using and cross-border needs, but we're there to help them for exactly that.
John Dugan, wonderful to see you. Thank you so much for being with us. That was John Dugan, the chair of Citigroup's board. And John, I'm going to send it back to you.
Lisa, wonderful conversation, as always. More from Lisa a little bit later this hour. Jason Thomas, the head of global research and investment strategy at Carlyle, joining Lisa later this hour in about 20 minutes' time. I want to check out shares of Apple just quickly in the pre-market, down by 0.9%. Some real anxiety going into earnings in the next week. This coming from KeyBank this morning. Apple's business, while its valuation appears expensive, they downgrade the stock over at KeyBank.
Meanwhile, Tim Cook is there. He's sitting down in a meeting right now with China's commerce minister. We have seen him also take to WeChat and other social media platforms in China, filming selfies, talking to local Chinese social media stars. A massive push into this market because they have to be. But what's China doing? They are losing market share almost every day, it feels like, every quarter, to national champions like Huawei in China.
More on that stock in just a moment. For the broader market, equity futures up by 0.2% on the S&P. Up next on the program, Neil Dutta of Renmark with US payrolls due a week from today. The payrolls report, 1 week away, the estimate in our survey, 120K. Your equity market on the S&P 500 with a little bit of a lift this morning across the board on the S&P 500. Positive from New York. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Apple down this morning, 0.9%. KeyBank cutting the stock to underweight from sector weight. Here's the quote from them. Apple is an impressive business with what we believe are unrealistic expectations to re-accelerate growth across all product categories and geographies. We're down 0.9%. The earnings a week away. Equity futures more broadly on the S&P on the NASDAQ doing okay. Equity futures up by 0.2% on the S&P. Likewise on the NASDAQ, up almost a third on a Russell. In a bond market, a 2-year, 10-year, 30-year shaping up as follows. Waiting for that payrolls report to drop in a week's time. 419.40, yields are lower by 2 basis points. We're down 2 on a 2-year to 4.05%. And in the bond market, it is all about payrolls next week.
That's what Mohamed El-Erian is talking about. He's looking at more of the economic indicators when it comes to the bond market, not this idea that potentially this is a Trump trade that's being put on. But how difficult is this payrolls report going to be? Everyone we speak to on this program has said, look through the bad data, the hurricanes, Boeing. Our Bloomberg Economics is talking about a negative print. What does the Fed do with that?
70K is the low in our survey. Stephanie Roth's going to join us a little bit later from Wolf Research. Joining the program in about an hour from now. The high is the 160-something. We were talking about taking off, I think, 100K. Governor Waller talked about 100K off the number, off the back of the strikes and the hurricanes. And here we are a few weeks later. Claims are back to pre-hurricane levels. I've got no idea how much we should take off next week.
But is just 100 because the impact of weather and strikes? Or do you have to add another 60 because of how the Department of Labor collects their data? And already we know the revisions usually are to the downside.
Neil Dutta's going to have his own thoughts on this. Neil Dutta's about 5 minutes away. Under surveillance this morning, the U.S. exploring different options to restart stalled talks between Israel and Hamas. Secretary of State Antony Blinken said negotiators are set to meet in the coming days.
So look, we've been here how many times? Deals potentially on the table. You don't see the movement from the Israelis, and really you don't see the movement from Hamas, who continues to dig their heels in and don't agree to anything. Of course, the United States is going to push for this. And part of this is not just the fact that Secretary Blinken is in the region, the 11th time since that October 7 terrorist attack, but they have to keep the dialogue going, especially now, because we are less than 2 weeks out from a U.S. presidential election.
So if you're Israel, what do you do? 2 weeks out, it might be Donald Trump back in the White House. Are you going to wait? Going to wait to make big decisions?
I think for Israel, just, you said you're chief of Mossad, as you said you would, to Qatar, and you have these negotiations, but potentially you don't do anything massive before the election. And I'm still waiting on whether or not we're going to see that retaliatory strike. There was a leak from the United States, and potentially Israel's waiting for a lot of things to cool down, the secretary to leave the Gulf, but maybe even waiting for the U.S. presidential election, get that over with, and then look at potentially all their options.
Going into another weekend, waiting for the same thing. Brent crude up by 0.8%, just short of 75. WTI this morning, $70.81, up by 0.9%. Let's get into the election and the campaigning. Donald Trump and Kamala Harris entering hostile territory this weekend. Trump holding a Saturday rally at Madison Square Garden here in New York City, as Harris is said to hold several events in Texas, including a rally with Beyonce.
So this is interesting because I think Evan Roth-Smith nailed it this week on our program, saying this isn't about trying to win votes for the top of the ticket in New York if you're Donald Trump or in Texas if you're Kamala Harris. It's shock and awe. How do you win that news cycle? You win that news cycle by showing up and quote unquote playing the garden, which is what people close to the former president tell me. Reagan won re-election in a landslide in 1984. That was the last time a Republican carried New York. That's not going to happen. Kamala Harris is not going to win Texas. But this is a moment for her, one, to highlight reproductive rights in a place where there's stringent controls on women and abortion access, and also hometown of Beyonce. That could potentially win a news cycle. That's what they're trying to do.
Win the news cycle, but convert how many voters? How many Beyonce fans haven't decided who they're voting for?
I don't have data on that, but I'm
remember
sure
the
it's
Taylor
not
Swift
a lot.
conversation. How much was it actually going to change? How much does this change?
I think for Taylor Swift, it was about registration. You did see an uptick of individuals who clicked on her link that she shared, so you're able to track what that registration was looking at. Do they go out and vote? We don't know. Beyonce has done this, though. She performed, I think, 3 days before the presidential election in 2016 with Hillary Clinton.
Yeah.
It didn't work.
Purely from the perspective of entertainment, looking forward to Trump and Rogan.
So am I. Do you know why?
Today?
Because they have beef. Rogan at one point was a Bernie Sanders supporter. He also said, I'm not giving Trump airtime and access to my 15 million individuals because I don't support him. He also has been quite kind to Kamala Harris. That campaign was even considering going into the lion's den of Joe Rogan. They're not going to be doing that. She's sitting down with Brene Brown, going after women.
That's a little bit different to the conversation we could see on Rogan. Let's talk about what's happening in the restaurant business. More fast food chains pulling onions on E. coli fears. Locations under Yum brands, including Taco Bell, Pizza Hut, KFC, all removing onions tied to Taylor Farms out of the abundance of caution. McDonald's is working with health authorities to confirm the source of a contamination affecting 13,000 stores.
So you have to think the Taco Bells, the KFCs, of course they're going to do this. You have to be prudent. And why? Because historically, we know what happens to companies, we know what happens to their trust in consumers, and we know what happens to their share price when they're not. You go back to what happened with Chipotle, double-digit losses when they couldn't really contain that E. coli outbreak.
We've seen what's happened with McDonald's this week. The stock is lower so far this week by almost 5%. Looking ahead to next week, the October payrolls report 1 week from today. The median estimate in our survey expecting 120,000 jobs added after last month's blowout print of 254,000. Joining us now is Neil Dutta of Renmac. Neil, welcome to the program, buddy. We've got a ton of issues to work through. Let's just start with payrolls. Claims yesterday back to pre-hurricane levels. Walk me through how you're thinking, the process you're going through to come up with a number for this month that gets released next Friday.
Well, I think it's the way most of the street is. Going like that. No. You know, look, I think when I look at the jobless claims data, I think it's good that initial claims appear to be stabilizing at something close to where they were before the hurricane. But continuing claims have generally been going up still. And, you know, obviously they're lagged a bit. But, you know, for the survey week, we know that continuing claims hit a cycle high. And so what that probably means is that, you know, some increase in unemployment is probably inevitable with the next cut of the jobs number. In terms of how many people are affected by the hurricane, I mean, that's a little bit more difficult to game out. But certainly, you know, I'm going to be keeping an eye on manufacturing employment because of what that, you know, has to do with Boeing and the potential downstream effects of the strike across that company.
I know even if you take these issues away, you don't like the setup through Q4 into year end and into 2025. Neil, let's get deeper into that. What are the issues that you see that you think that maybe some people are ignoring at the moment?
Well, sure. I mean, keep in mind that aircraft equipment investment was a huge driver for GDP growth over the last couple of quarters. That's probably not going to be with us in Q4. At the same time, we know that business and investment intentions more broadly have been quite sluggish. So, you know, I don't think equipment spending is going to be the driver of growth in Q4 that it's been. Remember, that's contributing about 0.5 percentage point to growth in the third quarter. And, you know, the housing market, you know, whatever neutral is, it's got to be a lot lower for housing because residential investments going to continue contracting into into Q4. You look at the recent backup in mortgage rates, that's going to weigh on transactions. But more broadly, if you look at sort of new single-family homes that are for sale that have been completed, I mean, that's up 40–50% against last year. So I think inevitably you're going to see some weakness in single-family residential real estate construction. And we also know that multifamily construction is likely to keep coming down because starts are running well below completions in that sector. So I think residential construction activity is likely to be weak. And, in my mind, the labor markets are still broadly cooling. I do think that one interesting kind of wrinkle with the next cut of the jobs number isn't so much where October comes out, but what the revisions will look like for September. Because remember, the initial response rate on the September number was quite low for a September. So that doesn't tell us about which way the directions are, the revisions will be, but it does tell us that there will be revisions. So I think that's going to be pretty interesting. But at any rate, I mean, nominal income growth over the last 6 months, when you look at jobs, hours, and earnings, I mean, that's running about 4%, which is a lot weaker than the kind of growth in consumer spending that we've seen in the third quarter. So my sense is that you get a little bit of slowing in consumer spending as well. And obviously there's a lot of kind of, I think there's a bit of front running of the election. So if you end up getting what the markets are pricing, maybe there's not as much of a tailwind when it does happen.
Neil, we'll get to the election in just a moment. I just want your thoughts on the Federal Reserve. The Fed has basically communicated a bias to reduce interest rates. From what I understand from you, you believe they're needed. Do you see them wavering whatsoever based on what we've seen on payrolls, 254 for September, what we saw on retail sales just a week or so ago?
Well, certainly some are wavering, but I think that was kind of known because, 7 of the 19 officials in September were already kind of on board with skipping a meeting before year end, right? They only had 75 basis points worth of rate cuts baked into the outlook for the end of the year. I think the Fed will go in November. The markets appear to be flirting with the notion of a skip in December. And frankly, I think by the time we get to December, skipping the meeting will be unlikely because of the things I'm talking about.
Neil, is there a print that we could get that would put the Fed saying we're going to wait and skips November?
I mean, if you get another number like you did, last month, this month, I mean, even with all these hurricane effects, I mean, if you get that kind of run rate on a 3-month basis, I think that would probably change the Fed's thinking on the state of the labor market. But generally speaking, when you look at the totality of the data, I see labor demand continuing to cool. You look at job postings data, the Indeed folks have it on a weekly basis. That's been slowing. If you look at hiring rates, they haven't really gotten off the ground. Quits rates remain low. We just had the Beige Book, which is always released ahead of the Fed meetings. And, if you look at that, it looks like most of the country is actually flat to down. Only 2 districts are up. So there is a bit of a disconnect, I think, with some of with a lot of the data points that have been coming out. But generally speaking, my own view is that the labor market trend is probably a lot closer to where things were at the end of August than where they were at September.
Neil, let's get into the election, the politics, the policy, and financial markets. And let's maybe go back to 2016. We all remember the run-up to November 2016. Every single note, every single headline, particularly in the media, that the former president, Donald Trump, at the time, candidate Trump, would be bad for equity markets. And then we decided at about 4 a.m. that night, overnight, that he was going to be very good for equity markets. The story now, as you've identified, is that the former president is bad for the bond market. Can you tell me how you're thinking about the balance of risks around fixed income, given where people are positioning and how they're thinking about the outcomes of the election?
Well, certainly in every client meeting that I go to, no one I talk to really wants to be long duration going into the election because of what you're talking about, that the prospect of a potential unified government coming out of the election. But, so that to me suggests that a lot of this might already be priced in. If you look at sort of prediction markets, polling, I mean, I do think that this is not like 2016 when Trump was basically a 1 in 5 shot. The odds are a lot higher now. So I do think a lot of this might be priced in. But it's also important to keep in mind that, if you do get some kind of a sweep, where the House majority, if it does go to the Republicans, will be probably quite thin, right? I mean, it's already quite thin. So it's not like there won't have to be a lot of wheeling and dealing that needs to be done to get things, over the finish line next year. So I think it's going to be still, like, even if it's a unified Republican government, that doesn't mean that the Trump team's just going to be able to steamroll whatever it is they want through Congress.
That's true for taxes. It's not true for tariffs, Neil. So what could that implication be?
Well, again, I mean, if you get what is being proposed, that would obviously be bad. But it's also, that was also true when we were talking about these things in late 2016, early 2017. But remember, the fact is that the tax cut law actually sunsets at the end of next year. So that should focus the mind. I mean, remember, it's about the sequence of events. It's about the sequence of events. I don't necessarily believe that tariffs will be the first thing out the gate. It'll probably be focusing on the tax law. So if you remember the kind of sequence, the first time, and again, this is still a toss-up race, but if it was Trump, in 2017, he was the market's best friend because all the sort of things that were going on in DC was about sort of growth-friendly initiatives, deregulation, getting the Tax Cut and Jobs Act passed. And the fact that the law sunsets at the end of next year may focus the mind, particularly because you need Congress to get that done. So, and then when they're all campaigning in, the year after, in 2026, maybe that's when, the tariff discussion comes to the fore. So I think it's about the sequencing. I don't think that, this is the sort of, vote harvesting season. Everyone wants to sound tough. That doesn't mean that, I think it's important to take, some of these things that are being proposed here with a little bit of a grain of salt. Not take it completely literally.
Always great to catch up with you, sir. We take you literally. Neil Dutta of Renmac. Thank you, sir. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Tesla CEO Elon Musk and Russian President Vladimir Putin talk regularly. The Wall Street Journal reporting that the two have been holding conversations since 2022. The paper cited U.S., European, and Russian officials saying that the two talk about personal topics, business, and geopolitical issues. The owners of the cargo ship that caused the collapse of Baltimore's Francis Key Scott Bridge have agreed to settle a civil lawsuit from the United States. Two Singapore companies have agreed to pay $102 million, which will go towards the cost of cleaning up the wreckage. In the lawsuit, the U.S. said the companies used an ill-prepared crew and, quote, cut corners in ways that risked lives and infrastructure. The New York Liberty were greeted by thousands of faithful fans as they celebrated their championship with a ticker tape parade through the city. As many as 80,000 fans came out to celebrate the Liberty's first ever WNBA title. The event culminated with a ceremony on the steps of New York City Hall. It was a welcome sight for the city, with the last sports-related parade happening over 5 years ago after the U.S. women's soccer team won the World Cup. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the program, a growing debt pile, all but guaranteed.
The next president, whoever that may be, and next government will have to deal with fiscal sustainability, and interest rates will matter for the government, not just for the economy.
That conversation up next.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Equity futures on the S&P up by 0.25%. In the bond market, yields a little bit lower, down 3 basis points, 418.21. Out of Savannah's this morning, a growing debt pile, all but guaranteed.
Either way, you're going to see a rise in overall debt outstanding, and this is where it starts to really matter. I think the next president, whoever that may be, and next government will have to deal with fiscal sustainability, and interest rates will matter for the government, not just for the economy. And so as we get towards 5% or higher, it's going to really start to challenge the ability to spend like we have been.
So here's the latest. Trump and Harris both outlining plans projected to increase the national debt. Jason Thomas of Carlisle saying fiscal issues will persist irrespective of who wins the election. History suggests that governments only engage in deficit reduction on the required scale, here when it's perceived as necessary to reduce borrowing costs. Jason joins Lisa in Washington. Hey, Lisa.
Hey, how's it going, John? Jason is here, and I do want to start there. This idea of typically when people worry about the deficit, it starts to get priced in. It is not, unless you think that what we're seeing right now with yields rising really has to do with that. Is that the case? Do you think that long-end yields rising has to do with the deficit, or does it have to do with other factors?
Well, I think that it is, of course, the deficit is contributing to nominal GDP growth. It's contributing to inflation remaining closer to 3% than it is to 2%. So I don't think we just need to look at a risk premia in the market or in terms of the backup in long-term yields. We just need to appreciate the deficit today, 6.5% of GDP, but at full employment. So this is quite different than the deficits from a decade ago. Also similar proportion relative to the economy, 6.5%, but coming at a time when unemployment was 8%, when tax receipts were depressed, when social services spending was relatively high. So what's different here is that when you adjust for the state of the economy, the Treasury is injecting about $1.5 trillion of incremental liquidity into the economy. And that, I think, is something that people have to take into account when bond yields and, again, inflation, nominal GDP growth.
So we were talking before the break, and there is this question of whether we're actually just seeing people figure out that the neutral rate might be a lot higher. Right now we're pricing in about a 3.4% rate at the end of next year for the Fed funds. But right now it seems like maybe you think that the market is just adjusting higher and is going to kick that back up to something closer to 4. Is that right?
I think that's reasonable expectation. The way that I've related the current experience is similar to the taper tantrum. The reason I say that is because in 2012, everyone was convinced that bond yields were unnaturally low. The expectation was that as soon as the Fed stops purchasing assets, bond yields are going to spike, and they're going to normalize. What happened, of course, when Bernanke in 2013 shocked markets, the Fed followed through, stopped buying bonds. By the end of 2014, within 18 months, bond yields were about the exact same level as when Bernanke first surprised markets with the suggestion. So then from that point on, people started talking about R-star. They started talking about the fundamental determinants of real interest rates. And people recognized that monetary policy could not be the entirety of the explanation for why rates were so low. Today, I think that there was this expectation, we had this temporary spike in rates because the Fed was focused on maintaining credibility, getting inflation down, and that we would then go back to 2.5% thereafter. And now they're realizing that there are really seismic structural changes in the economy, the shock from AI, the industrial policy and the capital needs there, changing attitudes towards trade. And as when you accumulate these factors and take stock of them, you end up with a inflation stabilizing interest rate that's probably closer to 4%. And I think this is just the market digesting that.
Do you think it's a mistake at this point for the Fed to cut further?
No, I think that as inflation goes down towards 2%, you would not suggest that this economy requires a real interest rate of 3% or close to 3%. So I think there's at least 2 more cuts that are coming, maybe a third, we'll see. But when the Fed first cut rates in September, the market had priced 10 cuts over the next 12 months. So I think it's just dialing back those expectations, but rates are still coming down. I think that's virtually assured.
Just really quickly here, even if the Fed doesn't cut, do you think that risk assets are in still a sweet spot, particularly in the private credit sphere?
Well, I think that what is underappreciated about this economy is that a relatively small share of GDP, relatively small share of the economy, is making such an outsized contribution to growth. According to our data, really it's about 4% of GDP, adding almost a full point to growth. That's of course data centers. It is that's the infrastructure, and in addition to the hardware applications, it's renewable energy generation facilities, green industry, things like EVs, battery, semiconductor fabrication plants. And so I think that this economy is actually performing better than expectations, certainly better than people expected 2 months ago as they really started to worry about a couple of soft months of data. And as a result, I think that there's reason to suspect that there's a lot more runway for growth than people had been anticipating.
So yes, it seems like a good time.
No, I think you have to worry about valuations. You have to worry about, are credit spreads too tight? I mean, so there's, there's a lot of complications, but I think the underlying, the tailwinds are sufficient.
Jason Thomas, thank you so much for being with us. John, I'm going to send it back to you.
Hey, Lisa, thank you. Great work as always. Coming up in the next hour on Bloomberg Surveillance, we'll catch up with Tom Kennedy of JP Morgan. Bloomberg's Ed Ludlow looking ahead to a massive week for tech earnings. Stephanie Roth of Wolfe Research looking for 70K on the payrolls report next Friday. And we'll speak to Sonia Meskin of UBS from New York City this morning. Good morning. The third hour of Bloomberg Surveillance up next.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Well, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. When I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
There is a sense, I think, that the markets are increasingly worried about some kind of fiscal risk.
Companies are just a little less optimistic than they were a few quarters ago.
The issue of the year has really been whether we would broaden out, and I would say that is happening.
When you look at equities, we're going to get growth, right? So, forward returns are just going to be much more muted.
Corporate America is sitting there saying, I'm in a pretty good position. The economy's doing well.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
We've got such a big week coming up for you. Earnings from Alphabet, Microsoft, Meta, Amazon, Apple, all coming up next week. The climax of next week, payrolls. Payrolls Friday just around the corner. Equity futures on the S&P 500 into all of that. Firmer by 0.25% on the NASDAQ 100, up by 1/3. In the bond market, yields have been climbing all week by double-digit basis points on a 2-year and a 10-year. We retreat. We're down 2 basis points, 4.19 on 10s on 2s, 4.05%. As for the guesses for next Friday, 120. The median estimate in our survey, this just drops from Citi. We expect a soft 90K new jobs and a 4.2% unemployment rate next week.
And Andrew Hollenhorst goes on to say it may take until December for the market to turn attention back towards recession risk. Why? Because we had that blowout jobs report. You've said it all morning, Jonathan. The upside surprise potentially we could see in next week in that jobs report following that jobless claims. How much is the hurricane going to be priced in? And if it's not, what does that mean for the Fed?
2 weeks ago, the only thing we talked about was messy data. Messy data off the back of 2 hurricanes and a strike over at Boeing. And here we are with jobless claims back to pre-hurricane levels and people scratching their heads. What kind of number do you put in for a guess for next Friday?
I don't know, because Bloomberg Economics is talking about a negative print. And then if you take off, say, what Waller said, Governor Waller, take off 100,000 because of this messy data, the hurricanes, the strikes, but then you also have to take off another 60 or 70 just because of basic revisions that you have to slap off any job report that comes out. It's very difficult. And then it's noisy. Because what do you hear from businesses? What do you see in the Beige Book? The presidential election has businesses on the sideline, potentially not wanting to hire or fire until they get a little bit more clarity on what policy looks like 2025 and going forward.
The former president sat down with Bloomberg a few weeks back, and he told John Micklethwaite that perhaps Chairman Powell had the easiest job in Washington, D.C., and perhaps you agree with him. But let me tell you, in a few weeks' time, that is not going to be an easy decision to make. They'll have a distorted payrolls report, possibly, an election without an outcome, potentially, and on November 7th, they've got to make a decision. Now, they've got a bias to cut interest rates. They've communicated that quite clearly. What we're asking is what would upset that bias to reduce interest rates? How big would that number need to be next Friday?
I think we're hearing from a lot of analysts, anything north of 150 to the 200,000 a print range potentially gets the Fed a little bit more nervous, looking back at the labor market in terms of, do we see this weakness? But more people are actually thinking maybe it's December that they'll have to miss, because it's pretty much November's baked in. Or maybe, because it's the blackout period, they start calling up some of their friends in the media.
Counting you down to a big few weeks ahead, and let's hope we don't have to do all that all over again. Equity futures on the S&P 500 firmer here by about 1/3 on the S&P, up around, or rather down around a basis point or two on a 10-year to 419.60. Coming up this hour, we'll catch up with Tom Kennedy of JP Morgan as the S&P 500 heads for its first weekly drop in 7. Bloomberg's Ed Ludlow previewing next week's big tech earnings, and Stephanie Roth of Wolf Research on why no landing fears haven't run their course just yet. We begin this hour with equities inching higher as investors digest upbeat earnings and strong economic data. Tom Kennedy of JP Morgan eyeing the upcoming election and saying the following: elections can stoke volatility, but interestingly, equity volatility has been relatively low for an election year. In the long run, elections don't drive financial assets, but you'd be forgiven if you thought this time is different. Tom joins us now for more. Tom, good morning.
Good morning.
Is it different this time?
I don't think it will be particularly different. The equity volatility point is very interesting to me, in that we're talking about this being a very polarizing election, and socially that does feel that it might be that way. But in the market, realized and implied volatility all year has been very low. Implied volatility for October and November, historic averages, nothing real special about it. I think the market, as it always does, recognizes that earnings, growth trajectory, Fed trajectory are really what matter the most. And at the moment, we're sitting at a place where the soft landing has happened and the Fed is incentivized to keep it going.
That's an equity market observation. Can you say the same thing about fixed income, about treasuries?
No, you're totally correct, John. The equity volatility very low, fixed income volatility very high. As we're trying to sort out exactly where the Fed should cut to, just look, 2-year ahead expected Fed funds rates this year have moved between 275 at the low end and 4 and almost a half at the high end. This is unbelievable uncertainty about where things could go.
Path of least resistance, higher or lower yields. How are you thinking about that?
I think that's the place where things get interesting for the election. Is the election the Minsky moment for the deficit? Lots of very prominent commentators talking about that. And months ago, it could have been the budget deficit issues, the budgetary annual rounds there. I don't know if this one is. It's possible, but we don't even have really good analogies for where rates could go in that scenario. For the most part, people throw out 5% just because it's a round number and it's high from here. But we don't really have a great analogy. That aside, I do think rates to the low end for the next couple of years is the right thing, mostly because the Fed is biased to cut. And that should perpetuate unless you think the labor market will tighten magically, which doesn't seem the case.
If a Trump trade is, or a Republican sweep really, is being priced right now into bond market, what happens if we don't get that?
Yeah, you should see rates rally, absolutely. At the moment, we have a Republican sweep scenario, 10's around 4 1/4. And that's for the most part where we're at. So in the event we don't get that outcome, I think you should see rates rally, and you should see some of it a relief rally in equities.
When you're looking at volatility, what does the volatility look like after the election? Maricopa County officials are talking about maybe not having Maricopa County, which is the most populous county in Arizona. Maricopa County goes, the election goes for that state. Yep. If they don't have that result and there's a contested election, what does volatility look like in the financial markets?
Yeah, it's a good question. How long do we allow this uncertainty perpetuate itself? If it's a couple weeks, maybe volatility doesn't pick up materially, like where's the expectation? This goes on for a month, we should see volatility pick up. And the question becomes, when do central bankers need to step in if volatility is so big? I don't know the answers to those things. Those are the questions that I'm sure are being asked in Washington.
Do central banks and investors just load up on gold?
It's been the trade so far this year. The way, I think there's really 4 ways to think about the fiscal situation. Everyone's worrying about a meltdown. Well, we can pontificate about when the Minsky moment is, but what do you do about it? First and foremost, I think you see investors shorten up on their duration. That has been happening in our community, JP Morgan Wealth community, a little bit. Add more gold, that's been happening.
Yeah.
Think about international diversification, or more importantly, think about real assets. We put out our long-term capital market assumptions last week, and in there, expected returns on real assets are expected to outpace global equity markets for the next 10 years. So there's something to think about in there for global investors.
I don't think we have to benchmark necessarily to the extreme. It doesn't have to be a crisis or not. There could be something in between. Let's look at the policies on the table. It was interesting for me to hear you say that red sweep 420 kind of makes sense on a US 10-year. And then I'm thinking, well, okay, let's think about the proposals on the table.
Yeah.
Tax cuts, lots of them. Tariffs, lots of them. Deportations, lots of them. That should come potentially with initially hotter inflation and potentially stronger growth.
Yeah. I think there's two scenarios in the red sweep that we need to discuss. The first is this pro-cyclical, higher growth, higher inflation scenario, but the deficit's not a worry. 4.25 represents a world where the Fed is going to be exceptionally gradual in its rate cuts in response to that policy. But the red sweep where we wake up and it's the Minsky moment, that's where treasuries can really sell off and equities would sell off. That's the differentiator there. In our baseline scenario for a red sweep, I think it's a pro-cyclical environment where risk assets perform well, the broadening in the equity market continues, and rates are higher for longer.
So let's sit on the equity piece of it. You can see why this would be positive. There's a conversation about taking a corporate tax rate down to 15%. With conditions, I'm not sure what those conditions are. Do we know what those conditions are still?
Nope, continuously ask. We don't know yet.
Still looking for some detail. So next week we get Alphabet, Microsoft, Meta, Amazon, and Apple. This isn't going to be a tech story. That's not what I'm hearing here. Is this going to be a small caps, banks? What kind of trade are you putting on?
This is potentially an industrial revolution for America, where the artificial intelligence infrastructure, which is wildly insufficient for AI adoption, that could come very quickly. And that's a power discussion. That's a real estate discussion, data centers, of course. But it's intersecting the economy in a really interesting way, and an election that now is trying to separate from China, but China has vertically integrated itself into that supply chain of tomorrow. The example that I like the best is large cell lithium-ion batteries. 50% of them are imported from China to America. So it's only 50%, no big deal. Well, when you look at the materials, the refinement of the critical minerals in a battery, it looks like just about every single large cell battery touches China at some point. So how do you separate when they vertically integrated, and yet you need the power, you need the supply, you have a renewable transition? This CapEx looks wildly durable in the industrial space, and for investors in our community, it's try to diversify, get more confident about where the earning streams will be. Amazon, Meta, Google, Microsoft, your hyperscalers that you mentioned, John, really confident they're going to keep going there. They need that infrastructure for AI to be successful.
To that point, Torsten Slok this morning said we need to add 3 New York cities to the U.S. power grid by 2030 to basically make sure you can power everything you're talking about. But why is that a Trump trade? I feel like that's going to happen under whoever becomes U.S. president.
Completely agree. In the way that you think about investing, how can I have all the scenarios and win in all the scenarios? I think this is a trade that's going to work either way. And it's not a trade, and it's really an investment process, because this should go on for 1 to 3 years. And the real crux of the supply and demand imbalance is, when do we think most businesses use artificial intelligence? A couple years? Well, the Power Authority in Virginia, where most data centers are saying prices are going to go up a lot, and you're going to wait a long time to add a data center. So this supply and demand imbalance is real.
We've started to see the trade spread out, the second derivative into utilities. We've seen a massive year for utilities. What's lagged? What's the next step in this AI trade? What's next?
I still think utilities have our top sectors. Utilities.
Into next year.
Industrials. Tech is a part of that. And now how tech performs will inform how these other two, they're connected. These are not traditional cyclicals or defensives. They are part of this infrastructure ecosystem build out and tied to technology. We think those are the two best sectors to be holding into the election and into next year.
Do you think these tech firms need to demonstrate a more powerful use case for the end consumer, for the investors in them to carry on being patient, retain this tolerance for them to keep spending billions of dollars on chips out of NVIDIA?
So far, the spending on artificial intelligence out of these big names is mostly out of free cash flow. I think that buys them time to keep doing the CapEx, because it's being financed and funded just from earnings. If earnings growth is going to slow next year, it is a dominant question in our community. How patient can we be with price to earning multiples this high? Diversify now. Most of our clients are still very overweight U.S. tech. It's been a great trade, amazing trade. But can you diversify and find better ways or less risk ways to get your portfolio where you want it to go? I think yes.
Tom, it's good to see you. As always, great to catch up. Tom Kennedy there, of JP Morgan on the bond market, the election, and the pockets of the equity market that he likes right now. Equity futures on the S&P 500 up by a third of 1%, with an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Shares of Capri Holdings plunging nearly 50% in the pre-market after a federal judge blocked the company's planned takeover of $8.5 billion takeover, that is, of Tapestry. The judge said allowing the owner of Coach and Kate Spade to buy the Versace and Michael Kors owner would harm competition, creating a company with a 59% share of the accessible luxury handbag market. Mercedes-Benz is planning further cost cuts as it faces weaker demand in China. The luxury car maker's profitability fell below its minimum target in the third quarter to its lowest since it split from the truck business in 2021. It's a sharp contrast to Tesla, who reported robust earnings tied to strong performance in China. And it is a good day to be Lionel Messi. The MLS Players Association released its salary update, revealing that Messi earns a $12 million annual base salary and a more than $20 million in total compensation. His salary is more than the entire payroll of 22 Major League Soccer teams. And that's your brief, John.
And he's still the only reason we're talking about the league. My opinion, I know, and I'm sure other people share it. Danny, thank you. More from Danny in about 30 minutes' time. Up next on a program, The Morning Calls, plus Bloomberg's Ed Ludlow, ahead of a massive week for tech results next week from New York City. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
I knew, as soon as I said it, criticized MLS, I'd get pushback. Pushback from Cincinnati, where apparently the MLS is a big deal. I promise you I'll attend a game. Maybe not in Cincinnati, but I'll make it happen. Equity futures right now on the S&P up a third of 1%. Bond yields lower by a single basis point, 419.60. The opening bell, 1 hour and about 13 minutes away. Let's get you some morning calls. First up, Citi, raising its price target on Tapestry to 55, saying the blocked acquisition of Capri simplifies the company's story. The stock is up by 15. The other name is down a heck of a lot. Next up, Raymond James downgrading T-Mobile to market perform. The analyst saying his thesis has played out. That stock is down 2%. And finally, the big one this morning, KeyBank downgrading Apple to underweight, citing unrealistic expectations and an expensive valuation. Sticking with big tech, a slew of companies set to report earnings next week, including 5 of the Mag 7. Alphabet kicking things off on Tuesday, followed by Microsoft and Meta on Wednesday, Amazon and Apple on Thursday. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the show, sir. We've got some time to work through this. Let's start with yesterday before we get deep into next week.
Oh, sure.
Tesla, 22% move. Ed, just Just frame that move for us historically. That's a monster one.
Yeah, I think the biggest move in almost a decade, right? And I think what's so interesting about the Tesla print, and discussed it with a lot of investors, is that we've discussed on this program about how Elon Musk's greatest skill is keeping investors looking to the horizon. So you kind of got that, a very bullish growth outlook for the core EV business, and then the kind of more sexy autonomous driving stuff further afield. But in the quarter gone, they demonstrated something which historically, to their credit, they've been very good at, which is being a profit machine, working out how to eke out more profit from the existing business lines. And that was notable, although I think there's a little bit of skepticism about some of the deferred revenues around the software that they sell. But yeah, you know, great quarter gone, bullish outlook looking forward.
And it wasn't just the percentage point move, it was the market cap move. $154 billion in a single day. And as our good friend Ollie Crook said earlier on this morning out of Europe, the combined market cap of VW, Stellantis and BMW doesn't even meet the one-day move we saw in market cap from Tesla just yesterday. What are they doing right compared to some of their European peers?
Yeah, I mean, Elon Musk threw some shade on the call, didn't he? He said, you try and name for me a single automaker in the world, either a pure play EV name or an automaker that has an EV division that is doing it profitably. And his argument was there isn't one. It's just Tesla. And that's probably true. I mean, just an extension of what I was saying a second ago, it's just the basics of running a large industrial global company, right? They have managed to pull down their raw materials costs and refine the production process. And then they benefited hugely from, to your point, John, regulatory tax credits. Right, which they sell, and the other automakers have to buy from them. Why? Because the other automakers aren't doing a very good job at selling EVs, and it's sort of a self-fulfilling prophecy in that sense at the moment for Tesla.
Ed, you were on the call, and I know that Elon Musk talked about the factories in Mexico, and he said, we're going to make a decision. We have to wait for the U.S. election. He's talking about China being this growth driver. That's what Dan Ives told us yesterday. How much actually is Elon Musk waiting on this election where he supports the former president, but potentially the former president's policies actually might hurt him at Tesla?
Yeah, Anne-Marie, I'm really glad that you asked. And if I may, I wrote about this in the moment on the call because I felt it was really important. Musk did not name Donald Trump, and he did not use the word election. But what he was saying is that he wanted to see a federal level or nationwide regulation for autonomous vehicles. Tesla is currently pivoting its entire business toward that. And what he went on to say, quote, is that if there is a Department of Government Efficiency, end quote, then he would work to enact federal and nationwide regulations. For me, that is the CEO of a large publicly traded company saying that if the candidate that he is a backer of wins, then he is going to use that platform to enact and push for federal level regulation of the business line his company's entire future is pegged to. And I thought that was critically important.
Ed, a key piece of this puzzle at the moment is China. So let's talk about China and what it could mean for Apple. You've seen the downgrade that came from KeyBank this morning, downgrading the stock to underweight from sector weight. I'll share the quote with our audience who might have missed that this morning. Apple, an impressive business with what we believe are unrealistic expectations to re-accelerate growth across all product categories and geographies. What do we know about what's happening in China this quarter?
Yeah. I mean, the hard lesson I've learned in the last year, maybe 18 months, is one, be wary of the third-party data about Apple sales in China, because when earnings roll around, we're often proven wrong in some sense, right? You can definitely see that competition for Apple in the smartphone market in China is there, and that it materializes in their top-line growth. But also, too, we don't understand what's happening, frankly. There is a phenomena where Apple is selling the iPhone 16 in China, and there is some evidence that the consumer is buying it on the belief that in the future, Apple will roll out its artificial intelligence technology there. But it's not currently available there. The regulators won't allow for it, and Apple isn't deploying it. But it's a really interesting consumer behavior that is impossible for any sell-side or third-party researcher to track, because it's a consumer betting on a future product that we don't have a timeline for existence. And when they roll around, that's when we'll get the iPhone 16 data, the real data from Apple. And I suspect that it will be interesting to see if iPhone grows and other categories from Apple in China do not, as has been the case in prior quarters.
So, Ed, there is zero timeline for when those individuals, those consumers in China that decide to buy this iPhone are going to get access to the AI technology?
Yeah, I mean, the notable story of this week, of course, was Tim Cook being in China and meeting with relevant government officials who are part of that regulatory body. Apple has a unique position for a US company in China that maybe only Tesla also shares, that it moves with relative freedom, both in its end market for sales, but also in its supply chain. But they can't decide when they deploy a technology like this, Apple Intelligence. It's at the whim of regulators. And as we know, particularly in the context of video games licensing, for example, regulators can change their mind very quickly, or they can take a very long time to do something. Modeling for that is very hard, though I'm not a sell-side analyst. I'm a journalist.
Well, you mentioned Tim Cook. He met with the Commerce Ministry of China today. He's also been on these tours, taking these selfies. You see how government leaders are reacting towards China versus business leaders. Look at the way Elon Musk and Tim Cook react towards China, but look at the way the two leading parties in the United States, the Democrats and the Republicans, bipartisan support for talking tough on China. For Apple, what does the future look like if we get a Trump 2.0, which is being priced into the financial markets?
Yeah, I don't think we know that answer. I mean, interestingly, you know, what I took from that recent interview with Micklethwait was basically Trump feeling that he has a good relationship with Xi and a good relationship with China, and that he would do something in American interests. But we have been through one Trump presidency, 2016 through 20, where other than that sort of latter part of the pandemic that muddied the waters, Apple was fine. You know, it has de-risked its supply chain to a certain extent, shifting some production to India and other parts of Southeast Asia. But critically, and it is relevant to NVIDIA as well, right, in the context of export restrictions, China is still the most important end market for everything from consumer electronics right through to data center and hyperscalers. And so we watch it closely. What Trump will or won't do, I think that's part of the problem. We don't have a clear sense on the policy platform of either when it comes to technology companies in this country.
Ed, massive week ahead. Looking forward to covering it with you, sir. Ed Ludlow. On the West Coast, you can watch Ed every weekday on Bloomberg Technology at 11 a.m. Eastern Time alongside Bloomberg's Caroline Hyde. Tim Cook proved to be a really effective diplomat throughout Trump's first term. And what we heard with Howard Lutnick just a week or so ago on this program, we talked about whether Apple would get carve-outs if they went big on tariffs, and he said no. And I wonder if he's going to ultimately change his mind once again.
Yeah, Lutnick said no one's getting a carve-out, not even Apple. Donald Trump has talked about the fact that Tim Cook would call him and say, look, this is what I'm dealing with in the European Union. This is what I'm dealing with China. Can I come in and walk you through this? And actually that personal touch from an executive was really important to Donald Trump, and it ended up being beneficial to Tim Cook.
Apple just a little bit lower this morning. We're down by 0.5%. The earnings coming up next week. Coming up next on this program, we'll catch up with Stephanie Roth of Wolf Research, looking for 70K on payrolls next week. And we'll speak to Sonia Meskin of UBS. From New York, this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
60 minutes away from the opening bell. Equity futures this morning up by 1/3 on the S&P 500. On the Nasdaq 100 up by 0.4. With an hour until the cash open, let's get you some morning movers with Manus Cranny. Morning, Manus.
Jonathan, a very good morning to you. The pain trade on Wall Street this morning is for the merger arbitrages. This is Capri down. Their lifeline, the merger with Tapestry, is taken off the table. Now, what does this actually do? Because this leaves this company exceptionally vulnerable. Think of the brands in there: Michael Kors, Versace, and Jimmy Choo. Where can they go to next for funding? You're going to see Tapestry at the bottom of your screen. A lot of people are saying, look, this is an escape for Tapestry. In other words, they're not going to be dragged down by these discounters, and indeed it emboldens their position. But if you want to get to the size and scale of Louis Vuitton and Kering as in Europe, you need to be able to do deals, and that is the drag potentially in the longer term for Tapestry. Size and scale is everything in luxury. Capital One, let's have a look at it. They have delivered numbers which were better than you saw from Ali Financial last week. Cards, auto growth, and credit losses down by over $1.4 billion. That gives them a little bit of a kicker this morning, which takes me to Skechers. The stock is up this morning 7.5%, 30% growth in EMEA, which was unexpected. They tanked and kitchen sinked everything back in September. They warned on China. And of course, there's a collection from Snoop Dogg, which you can get your hands on, Jonathan. I've got you down much more for Laura Piana, kind of Axel Aguido kind of guy.
That's a good read. I would say that's a good read.
Laura Piana.
I don't know a single person who wears Skechers. Nobody. Do you know anyone who wears Skechers?
I think for a while President Biden was, until he went to Hoka's.
Okay.
But I think you're more Brunello.
I think that tells you everything you need to know about that brand right now, but they seem to be doing well. Unexpected strength is what Barclays said, and I have to say it was unexpected to see. Manus Cranny, thank you. And Manus Cranny wouldn't be seen dead in Skechers either.
No way.
Let's be very clear about that, okay? Let's talk about payroll. Stephanie Roth of Wolf Research saying this: we're looking for 70K on payrolls. Despite being bullish on the economy, we expect significant noise in the report. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
You are bottom of the survey here at Bloomberg, and I think that was unexpected for you, 70,000. So I know you're not bearish. So let's just start with the 70 and tell us what's gone into that. What's the process that you and the team went through? How'd you end up at 70?
Sure, it's actually kind of simple. So the trend in payrolls growth is somewhere around 150,000, right? So that's a decent trend in payrolls growth, similar to where we were last cycle. Then you've got to knock out 33,000 from Boeing. And then our estimate for the payroll for the payroll's impact from hurricane is about 50,000, which is in line with the historical hurricanes of the past. So that gets you to something that's pretty weak, even though the underlying trend is just fine.
So claims came out yesterday. They're back to pre-hurricane levels. What does that tell you, if anything at all, about what we might see next week?
Yeah, so you saw about 4,000 increase from Florida. It's possible you'll see another increase for next week. If not, then it might tell you that our number's a little bit low and the hurricane had less of an impact than we thought. But even you had Governor Waller the other day out saying the combined impact from Boeing and the hurricanes could be 100,000.
Stephanie, what if you add in the basic revisions that people now slice off the non-farm payrolls report because we know about the data being difficult and noisy? Say you take 60,000 off. Is that included in your 70? Or if you take 60,000 off, maybe we'll get 10,000 for the NFP?
Well, so one thing to note is that in the revisions, and we saw positive revisions in the last print, we'll should probably see positive 2-month revisions in the next print as well, because you typically get positive revisions in the month of August and September on both the first and second prints.
Sounds like you think 70 is actually a good number for next week. Is that a good number?
I think it's fine because if in fact the hurricane number is kind of correct, when we look at the state data and we can confirm it was driven by Florida, then it's totally fine and the market shouldn't be scared of it.
What's the kind of number the Fed might be scared of? And by scared, I mean sit there and say perhaps we shouldn't cut interest rates by 25 basis points.
I mean, I think they could take Governor Waller's number, 100,000, knock that off the trend. So call it something below 50,000 would really get a lot of attention. The BLS also publishes the number of strikers, so you can easily add that one back.
No, I'm asking what would stop them from cutting at all, not going from 25 to 50. What would make them sit there and say, this jobs market is way stronger than we thought it was. Unemployment was climbing through the summer. We got nervous. We did a big Jackson Hole speech with Chairman Powell, came out and cut interest rates 50 basis points. Here we are, a few months later, 10-year yields are up by 60 basis points, and the 2-month average for payrolls is 200K. Should they be cutting interest rates?
Oh, it's such a tough one. I mean, I think it's really hard for them to not cut in November. In December, it's fairly likely they'll skip. So I think they'll probably just want to see a little bit more data, and then by December, it's very reasonable that they would want to pause for a meeting.
But Stephanie, he's asking for a number. Is it 200,000? What is that number look like?
Yeah, I think it's 200,000.
The line in the sand.
That's probably the line in the sand.
But you think that skip might come in December?
I think it's more likely December than November, but it's fair. I mean, and you should also start to see a little bit of headwinds from an inflation perspective from the hurricanes. That starts to put a little bit of upward pressure in the next couple months.
So your number for next Friday is 70, but as we said at the top, you aren't bearish, you're bullish. So walk me through what you're looking for through year end and into next year. What do these numbers look like for jobs, for inflation, and ultimately for the Fed's landing?
Yeah, so for jobs, we think that the trend is that 150,000. Forget about the next print that's filled with a lot of noise. But beyond that, something like around 100,000. We're looking for soft landing type prints, so inflation roughly around 2%, probably a little bit above, and you'll have a little bit of upward pressure in the next couple months just from hurricanes, so autos should see some upward pressure. That's a soft landing type of economy. We went from over the summer thinking it was hard landing, then the market narrative was soft landing, then it became no landing, and the result is probably somewhere in the middle where it's soft landing. That said, the no landing has probably not run its course yet. We're not quite out of the woods from that.
What does that mean? What does the no landing hasn't run its course yet? What does that mean?
That there's still probably upward pressure on rates in the near term. Combination of election uncertainty, pricing in the potential odds of Trump significantly raising up the deficit, and realistically both sides putting upward pressure on rates. So the no landing, I think, really manifests itself through interest rates. So that's probably where we would see it in the near term.
So in the near term, maybe the Fed holds in December. But how are they thinking about 2025 when you see the policies on the campaign trail?
It's a tough one. As of now, it's probably like an every other meeting type of pace until they get to something that's close to 3%. But it's a challenging one. And by the way, tariffs are, yes, they're inflationary, but they're also significant headwind on the economy. So chances are they're not going to be more hawkish on the back of that. If anything, they'll have to be more accommodative, or it just will keep them on pause for a bit.
The market right now is pricing in not just Trump, but potentially a red sweep. Tariffs. Trump can do that on day one. If he was to go there and start pulling the levers on tariffs, how does Jay Powell continue on a cutting cycle?
First of all, we do think he'll do it a little bit later in the year, closer to when they have to extend TCJA, in which case they can kind of tie those things together, the revenues that you're raising as a result of the tariffs. But let's just say, fine, let's say they do it at the beginning of the year. We think that could be an upward pressure on inflation by about a full percentage point at the least. I think the Fed's going to have to wait for a little while, kind of see how things shake out. Realistically, it'll probably hurt growth, in which case they're actually going to have to be more accommodative rather than less.
So just to wrap it up, where do you think rates are coming down to through next year? I know it's super hard to have a base case without really knowing what policy looks like through 25, but what is your base case for 2025?
On Fed funds rates?
Yeah.
Yeah, we think there'll be about 5 more cuts from here by the end of 2025.
Okay. And they skip December. That's the base case, or just a possibility?
Somewhere in between.
Okay, we're not quite there yet. Stephanie, appreciate it. As always, thank you. Stephanie Roth of Wolf Research, trying to work out what was published and what wasn't published just yet. Equity futures on the S&P 500 look like this. We're up by 1/3 going into the opening bell. The opening bell is about 50 minutes away, with the Nasdaq 100 up by 0.4%. On a Russell, we're up by about 1/3. In the bond market, lots to talk about. This week on a 2-year and a 10-year, up by double-digit basis points so far through yesterday. We come back just a little bit. We're down 3 basis points on a 2-year to 4.05%. On a 10-year, we're down by 2 to 419.40. And on a 30-year, we're up to about 446.32 and down a single basis point on the session so far. Joining us around the table, Sonia Meskin of UBS. Sonia, good morning. It's good to see you. Just had a conversation with Stephanie about payrolls next week. Base case for her, 70K. If you've got a base case, and how difficult is it to just pick a number out of the sky and roll with it for next week?
So tough, and we've talked about this before actually on this program specifically. The report that we got last time was probably the last clean report for the year, given all these hurricane effects and such. And Waller came out recently and said, look, this next report can be down by 100K just from the weather effects. So we just think that the Fed is going to have to look through this one-off weather impact, as horrible as it is for the communities that are impacted.
And as you know, this Treasury market has been doing much of the same thing, leaning on retail sales, upside surprise, jobless claims back to pre-hurricane levels. We've said that repeatedly through this morning. And we've had a move on a 10-year of something like 50 to 60 basis points since the Fed cut interest rates by 50 basis points. What's driving Treasuries right now for you? Because the debate we've had on this program, data or politics, politics or data, a mix of the two or one or the other?
We think, look, it's 3 things driving rates right now. Uncertainty around inflation, uncertainty around near-term growth with the fiscal trajectories from both candidates, and the broader fiscal trajectory of the United States that may potentially come more into focus as we near the election.
I'll speak to political strategists who say the proposals Donald Trump has right now and he's putting out there is worse for the deficit. You don't think that's true? You think both camps are pretty bad for the deficit?
Well, so we actually differ a bit from consensus here. We've done some modeling around this, and we think that Kamala Harris would probably extend the deficit by about $2 trillion, whereas Trump would extend the deficit by just over $4 trillion. In the grand scheme of things, in the wall of the entitlements that are coming more and more into focus for the markets, and also the TCJA extension, and then the immigration policies that would impact the labor market and therefore inflation and growth, we think that those differences are actually not the biggest.
So do you find it odd that the bond market is pricing in Trump?
Well, we think that, over the weekend, for example, we saw him improve in the polls. And historically, Trump has done a bit better in elections than polls have shown. So it's not exactly unusual that the market is giving him more credence right now.
Do you think we're well priced for it in the Treasury market? Because we've gone back and forth on this a lot. There is a massive difference between a Trump presidency and a full GOP sweep. And I've heard from the likes of BMO's Ian Lingen, who suggested that outside of a GOP sweep, it's difficult to see 10-year Treasury yields anywhere between 20, 30, 40, 50 basis points higher from here. How well priced do you think we are for either scenario at the moment?
Well, we think that fundamentally, if we start pricing in a wide deficit, like 7% of GDP going forward, while we're growing at, say, a trend of nominal 4% GDP. If this is not a good trajectory, this is going to drive the term premium up in and of its own, right? And there's going to be a crowding out effect in terms of growth. Then on top of it, we have the debt ceiling coming up, which can be punted further by Congress, for example, into next year, but increases uncertainty, therefore, for businesses and households. So there's lots going on in the Treasury market right now.
When you rank 2025 and the concerns, is it debt ceiling, TCJA, then tariffs? What gives you most the cause for concern?
Well, the tariff scenario is actually a very interesting scenario because tariffs only on China would actually not, in our modeling, have as big of an impact on the U.S. economy specifically as all-out tariffs.
Why?
Well, because all-out tariffs there would be much less of a substitution effect and more potential retaliation from the trading partners. So it's really a stagflationary environment, and that would be quite impactful.
But wouldn't China retaliate?
China would, but they're a smaller portion now of our economy. The interaction with them is a smaller portion of our economy than pre-COVID. There's been a lot of a substitution effect already.
We know how much this would hit Europe, and we've started to see a big divergence, a gap open up between the German 10-year and the US 10-year as well. Are you expecting some form of divergence through 2025 between the US and Europe, across growth, across rates, across central bank policy?
Well, we've had some divergence already, right? Other central banks have started easing a lot earlier than we have, and we've had stronger growth. I think one of the differences that we do see going forward potentially is what happens with inflation. Because we see inflation actually surprising to the upside into the first quarter of next year. And whether this happens in Europe or not, for example, is a different story. We also think, interestingly, that part of the decline in inflation globally has been not necessarily a central bank phenomenon. So that means that it's actually more difficult for central banks to control if we see upside surprises as well.
It's a really, really important final point. Sonia, it's great to see you. Sonia Meskin there of UBS. We've talked about this a few times. I think just to make it really, really simple, think about how the conversation has changed. In America, we've gone from talking about 25 or 50 to 25 or nothing. And in Europe, they've gone from meeting to meeting, 25 or maybe not, to 25 or 50. The two conversations in Europe and the United States have just completely reversed over the last month.
And you think about it, whose job actually is easier? I know Donald Trump liked to make a joke about it's the best job in Washington, you flip a coin, it's the easiest job. Actually, Jay Powell probably has a harder job right now, given how much the data is muddled. How easy is the job for Christine Lagarde? You have to cut. The growth environment is not good, and inflation is coming down.
Chairman Powell is going to have such a difficult news conference if we do not have a result from the US election. He's going to have question after question about policy, and he's not going to be able to answer it. Equity futures on the S&P up by a third of 1% with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. With just 11 days until the election, Kamala Harris is leaning into celebrity endorsements. The vice president was joined on stage for the first time by President Barack Obama. At a rally in Georgia, she was also joined by Bruce Springsteen. Later on today, she'll be joined by Beyonce at a rally in the singer's hometown of Houston. Microsoft CEO Satya Nadella received a pay package worth more than $79 million this year. That's a 63% increase from the year prior. According to regulatory filing, about 90% of his compensation was in Microsoft shares. The filing also showed his package would have been about $5 million higher had he not requested a pay cut to reflect his personal accountability for the changes the company is making to reflect cybersecurity risks. The New York Yankees and the Los Angeles Dodgers face off tonight in Game 1 of the World Series. It'll be the 12th time the two powerhouse franchises have met for the trophy, but the first time in 43 years. The series puts the spotlight on two of baseball's biggest stars, Dodgers phenomenon Shohei Ohtani and Yankees slugger Aaron Judge. The Yankees will hope to add to their league record with a 28th World Series title and their first since 2009. The Dodgers are looking for the club's 8th ring and their first since the COVID-shortened 2020 season. And that's your brief, John.
Danny, thank you. Thanks for this morning. Have a wonderful weekend. Up next on the program, we'll set you up for the week ahead, a sneak peek of next week, and why everybody's seemingly heading to Texas on the other side of this commercial break. From New York City, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
So let's call it 40 minutes away from the opening bout. The opening bout just around the corner, with equity futures on the S&P up by around 0.4% on the S&P 500. On the Nasdaq 100, up by 0.5%. Yesterday, the only positive day of the week so far. Snapping a 3-day slide. Let's see if we can add some weight to yesterday's rally. At the moment, poised for the first weekly loss in 7, snapping a 6-week winning streak, which was the longest weekly winning streak of the year so far. That's the equity picture. The bond market story looks like this: a 2-year, 10-year and 30-year yield through yesterday, up by double-digit basis points through the week so far. We pulled back just a little bit, erasing some of that move. We're down 3 or 4 basis points to the front end. At the longer end on a 10-year, we're down 3 basis points to 418. On a 30-year, a break of 445. 444.95 and down 2 basis points on the session. They're the scores going into the cash open in the equity market. Here's the trading diary through today, into the weekend and through next week. UMich consumer sentiment coming at 10 a.m. Eastern time on Monday. Ford reports Tuesday. The jobs data starts. It's JOLTS data, job openings, plus Google earnings, big tech. So many companies reporting, including the likes of Meta, the likes of Apple and Google. Then going through Wednesday for more economic data, we'll get initial GDP data. On Thursday, another round of jobless claims in core PCE. And then on Friday, it's the big one. It's payrolls. Take your pick next week. AMH, you've got massive tech firms reporting. And then you've got the big payrolls report. The estimate's 120, and the guesstimates out there at the moment are pretty wild.
They're all over the place, and I love how Stephanie Roth at 70K is the lowest on the street, even coming in lower, although she's bullish, even coming in lower than Andrew Hollenhorst, who we know is bearish, and he thinks it's going to be a soft 90K print. And then you have Bloomberg Economics, not part of the analyst survey, but they actually think we're going to get a negative print, negative 10K, because of all the noisy and muddy disruptions when it comes to things like the strikes and the hurricane. The issue is, what if it's a surprise to the upside? And the question that has for where this leaves the Federal Reserve 48 hours after U.S. presidential election, when they might not know the outcome.
This is how we started the show this morning. Jim Bianco of Bianco Research suggested that maybe the biggest risk for next week in the payrolls report was upside risk. Next week's a massive week. Before we get there, plenty more campaigning to do on the campaign trail. Harris and Trump are in Texas today, betting influential celebrities will help with a final election push. Bloomberg's Julie Fine joins us now from Dallas. Julie, welcome to the program. Walk us through why Texas is going to be so important for the next 24 hours.
Well, it's certainly important for Harris. However, she's got to know she's not going to win this state. But what she wants to do is refocus on the abortion issue. And she believes this is the place to do it. Texas is the state that began the strict abortion rules of 6 weeks. Very few exceptions, with the exception of the health of the mother. So therefore, she really wants to refocus to that. Also, she's got some major Texas star power with her. She will have Beyonce here. She will have Willie Nelson here with her. So listen, she can't simply say, I am not Donald Trump. What she wants to say is this is an issue that is very important to Democrats. I am going to what her campaign is calling ground zero for that. She will be with people that have personal stories about abortion, and she will also have Senate candidate Colin Allred with her. She's hoping to help him in his race. So therefore, this is big for her in that sense, in an issue sense. Let's talk about Donald Trump. Now, Donald Trump has used Texas as a cash register forever, but he has a lot of support here. He had to be here for Joe Rogan's podcast. So what he's decided to do is also use this as a backdrop for him. It has always been a good one when it comes to immigration, which has been a very successful issue for Republicans. So that's why they're both going to be here.
Julie, I'm really looking forward to that Joe Rogan podcast because those two men actually have a little bit of beef. I wish Kamala Harris was sitting down with Rogan because you have to sit for a full hour. And if you look at some of the past episodes, pretty much anything can happen. But you mentioned Colin Allred. I want to talk about that Senate race. Is it actually close? Can he unseat Ted Cruz?
I mean, listen, it is within the margin of error. It is a very different race, Anne-Marie, than the one in 2018 when it was Beto O'Rourke. The only similarity is that they both raised about $80 million. Will be with Donald Trump as well. Here's the situation here, though. I mean, you've got to get almost all of the independent voters. I was actually at a Colin Allred event last night. He, too, is talking a lot about abortion because he knows that resonates here. So for him going to be with Kamala Harris, it's somewhat of a difficult move for him because he's tried to run as a moderate very differently than Beto O'Rourke. But in this situation, he needs to be with Kamala Harris. And if he didn't show up, that's what people would be talking about, not the issues. So again, I would say it is about a 3-point race. It really depends on how Donald Trump does in the state. He won by 6 points back in 2020. Now in 2018, in the Senate race, it was not a presidential year. This time it is. Colin Allred running better in Texas than Kamala Harris is. So you have that to look at. I believe that it is about a 3-point race right now. It really comes down to turnout, and it also comes down to those independent voters, which he is trying very, very hard to get. Also, Anne-Marie, which I think you both probably found interesting, Ted Cruz also trying to run as a bipartisan in this race. Now, you know he is a very close ally of Donald Trump's. So it'll be very interesting to see.
Julie, great to catch up with you. Looking ahead to a busy weekend. Julie Fine there of Bloomberg going into the final full week of campaigning.
Well, it's going to be interesting, and I think Evan Roth-Smith nailed it this week, saying it's the shock and awe effect, wanting to get the headlines. Kamala Harris goes to Texas, deep ruby red, and Donald Trump comes to very bright blue New York to play, quote unquote, the garden.
And it's getting the attention that they were looking for. Tons of attention on those two individuals over the next week or so going into that election in the United States on November 5th. Coming up on Monday on this program, we'll catch up with Ambassador Ed McMullen. Big conversation with the man himself about his future. Will he be in a future Trump administration? Mike Dada of Roth Capital will speak to Victoria Fernandez of Crossmark and the Nobel Prize-winning economist Joseph Stiglitz on why he's supporting a Kamala Harris presidency. All of that and more coming up next week from New York City this morning. That does it for this week. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss.
I was a little shocked by how directly you called out Apple and their closed approach. Can you kind of expand on that and where Apple has been a blocker for Meta and potentially others?
Yeah, I mean, my point in there is more... It's a little more philosophical on how it's affected my own kind of approach towards things and psychologically sort of affected how I think about building stuff. I actually don't know how they're going to approach AI. They do some open development, they do some closed development. By the way, I think it's worth noting, like, I don't actually consider myself to be an open source zealot. I just think that in this case, I think that open models are going to be the standard, and I think that that's going to be good for the world. But we do open development, we do closed development, so I get it, right? And I'm not saying that Apple's necessarily going to be on the wrong place on this for AI. But if you look back over the last 10 or 15 years, it has been a formative experience for us, is building our services on top of platforms that are controlled by our competitors. And for a number of different incentives, they absolutely, from my perspective, apply different rules to kind of limit what we can do. And yeah, they have all these taxes, and at some point we did we've done some analysis that we think we'd be way more profitable if it weren't for some of these arbitrary rules, and I think a lot of other businesses would be too. But honestly, the money part, I think, it's annoying, but for me, it's not the biggest thing. It's, I think it's a little bit soul crushing when you go build features that are what you believe is good for your community, and then you're told that you can't ship them because some company wants to put you in a box so that they can better compete with you. And my concern for AI at this point isn't actually Apple. It's more the other companies and how that would evolve. And I think to some degree, it's not even that. I'm not even saying that they're like bad people. I think that there's just a physics and incentive structure to the system where, if you build a closed system, then eventually there are all these forces on you that sort of kind of push you to kind of clamp down on things. And I think that it will be a healthier ecosystem if it's developed more like the web, but more capable. And I think that, because of how mobile developed, where the closed model won, right? I mean, it's like Apple, I think, has really reaped most of the benefits in terms of, there might be more Android phones out there, but like Apple gets like almost all the profits from mobile phones. I think there's a bit of recency bias because these are long cycles, right? I mean, the iPhone, I think it came out in 2007, right? So
it's the end of a week that will likely post losses, even though we got green arrows on futures. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, equities on edge ahead of a tight election battle and big tech earnings on the horizon. Plus, deal stocks are dropping after a federal judge sided with the FTC, halting Tapestry's $8.5 billion acquisition of Capri. A look at the antitrust landscape for you ahead. And revving up Scout Motors. CEO Scott Keogh joins us on how he's trying to energize American auto manufacturing. Let's take a look at where markets are trading right now. We are up in terms of futures. You're seeing green arrows on the screen. S&P futures up 0.4%. NASDAQ futures, tech earnings powering NASDAQ even higher, more than 0.5% right now. And the 10-year yield coming down as investors start to buy these bonds that they had been selling off. But we're still likely to see a loss in terms of equities for the week. And if we do, Shonali, it'll be the first losing week in the last 7 weeks of session.
Certainly, it has been a terror. Crazy to see that bond market come full circle. We'll talk about that. But first, some stocks to watch. A lot of movement under the surface. New York Community Bank shares falling after provision for credit losses missed estimates. Remember, the stock had already been down more than 62% this year and down another 8.7% pre-market. But people are buying shoes. This is really interesting. Deckers Outdoor up more than 13% pre-market, higher after boosting its sales forecast for the full year. But Capri, as you were talking about, Matt, it's sinking 46% as a federal judge blocks a planned takeover by Tapestry due to handbag market competition concerns. If you saw my mother's closet, you would not have those same concerns.
I was thinking about the shoes. I don't know what shoes Donald Trump wears, if he is an Uggs guy or if he wears Hoka's, but it does seem like the Trump trade continues to profit. If you take a look at a couple of baskets of stocks, Dan Curtis, our charts producer put together for us. In red, you see the Trump trade there, Republican outperformers, and in blue, you see the Democratic outperformers, I guess the Harris trade. You can see that the Trump trade continues to accelerate, Shanali, and I also saw a note today from SocGen. They think the bond market has fully priced in a total red sweep, a Trump victory, and that, you know, you can start getting into that market now as yields may start to move lower after the election.
You have to wonder how far they move either direction, frankly, because you look at the 10-year, you were as high as roughly 425 earlier this week. We are down back firmly below that 420 level, so we've basically come full circle. Something I'm wondering about is what people are watching to determine that Trump trade, because you looked at what was happening on Poly Market, for example. Turns out it was only really one major whale among a few other smaller whales. But if that's something you're looking at to predict the outcome of the election, how indicative of it is it relative to those polls?
Yeah, I think the questions about Poly Market are legit and about betting markets in general, but polls have been wrong in recent big election events.
Nobody knows, let's be honest.
Well, predicted, I think, maybe a little bit better because it's more a market for academics. You can only bet a maximum of, I think, $850 on predicted. In any case, all of the betting markets have Trump fully ahead.
Somehow the next 10, 11 days are the longest and shortest 11 days of our lives.
Yeah, well, I think they're going to be
same time.
I think they're going to be long ones. Let's talk these markets with HSBC head of equity strategy for the Americas, Nicole Inouye. And Nicole, one thing is for certain, even though we may have a losing week, equities have just marched higher and higher. I believe you've moved your target higher for the S&P 500. Why do you think that this rally has more room to run?
Well, you know, as we talked about at the beginning of the year, there's always this bull case scenario for the S&P. And what was the bull case scenario? That GDP growth would come in above trends. We wouldn't see the slowdown in the second half of the year as the market was expecting. Inflation would ease enough for the Fed to start cutting rates. And all that would be very supportive for corporate earnings, and we're seeing that. So all the pieces are really falling into place for the S&P, for equities. You know, just looking at GDP growth for the second half of the year, you know, the market is still expecting a slowdown, but we're still seeing GDP growth growing very strongly. You're seeing actually consensus that continually needs to revise higher their GDP growth, so they're still behind the curve. And so we're always looking at this difference between expectations and reality. And really the expectations, I'd say, for GDP growth are low. We could see that surprising on the upside, and then also on the corporate earnings aspect as well. So first quarter earnings beat, second quarter earnings beat, and we're heading into this third quarter earnings season. It's still very early, but we're seeing almost 80% of the companies beating on an EPS and really going into this earnings season with expectations very low. So consensus is expecting earnings to grow only at a 4% rate, which is a pretty big deceleration from the 12% we saw in the second quarter. So we're going into this time with, you know, the macro looking very good, and also the micro in terms of company fundamentals looking very strong as well. So the combination of those two factors are very supportive for equities.
For sure, we continue to see, I was looking at the Atlanta GDP nowcast, as they ridiculously call it, and it continues to march higher. 3.43% is where we are right now in terms of their prediction. GDP is strong, as you say, and earnings have been pretty good, although it seems to me that a lot of companies are relying, maybe I take too much out of Harley-Davidson because I love the products, but a lot of companies are relying on continued interest rate cuts. Nicole, do you expect the Fed to continue cutting rates? I mean, would they pause? Because, as you point out, things look pretty good. There doesn't seem to be much reason to take rates down.
Right. Well, we've always had the view that we'd see a gradual easing cycle. So our expectations for 25 basis points of cuts over the next 6 meetings. I would say if we get a pause, if we don't get all those rate cuts, you know, at the end of the day, why are we not getting rate cuts? Because the economy is very strong. So I would rather see fewer rate cuts because you have a strong economy rather than more rate cuts because the economy is looking weak. And you know, looking at earnings, yes, Rate cuts is positive for those companies that have more financial expenses coming down. But remember, a lot of the companies on the S&P, first of all, leverage ratios have come down. Second of all, a lot of them have these fixed rate, very long duration debt. So I would say that the lower rates for many companies won't have an immediate impact, especially for these companies, these large companies on the S&P that don't have a lot of floating rate debt. I'd say maybe different for the small cap space, but I'd say for the large cap space, I'd rather see top line growth. I'd rather see the economy growing stronger rather than them getting better EPS due to lower rates.
I think another important part of this too, we can all get excited about a strong economy, but when do you start worrying once again that perhaps it's too strong to sustain a significant rate cutting cycle? You have, for example, Bloomberg Economics predicting an increase here in U.S. spending to contribute to more inflation for the core PCE for September. You know, what kind of impact does this have at the end of the day? Do you share the same concerns?
Yeah, of course, I'd say the biggest risk to this equity market right now is a reacceleration in inflation. So inflation actually picks up, and we get to the point where we're not saying, oh, the Fed is going to pause. We're going to say, oh, the Fed is going to start hiking. You know, we're not there yet. We're far from that. We continue to expect core PCE to decelerate at a gradual pace, and I think it will take various inflation readings of really strong acceleration for that view to shift in terms of what the Fed is going to do going forward. So again, we have this expectation of a gradual easing cycle. If it's not as much as we're expecting the markets pointing out, we don't see that as a huge negative because it's really showing that the economy is coming in stronger. And of course, at the end of the day, you're buying corporate earnings, and you want to see this strong nominal GDP, and that's what's feeding into this corporate earnings growth.
Nicole, great to get some time with you. Thanks so much for joining us. HSBC's Nicole Inouye talking to us about these markets. I want to bring in Bloomberg's Alex Semenova right now with a look at some of the movers that we're watching this morning, some very big ones as a result, especially of, you know, deal stoppage or deal slowage.
Yeah, so taking a look at Capri and Tapestry, this is obviously a big victory for the FTC, which has been vying now for a year to block this $8.5 billion deal. Tapestry is the parent company of Coach and Kate Spade, Capri of Versace and Michael Kors. Basically, the FTC had been arguing that the merger of these two would stifle competition in the accessible luxury handbag market. And a really interesting choice of words by the judge. She said, antitrust has come into fashion. So basically, the judge blocked this deal, and then the FTC will further explore the deal and see, you know, what kind of implications it has for antitrust. And it's also a victory for Lina Khan, which has been seen as a dynamite on Wall Street for antitrust regulation. Some critics have said that she should be focusing on other bigger mergers and not just luxury handbags.
And Matt, it's interesting. We are watching this in part. How many hedge funds had this trade on? Millennium, Hudson Bay, Pentwater, Citadel, Balyasny, Greenlight. A lot of people were betting on a Capri win.
So they're all burned now, basically.
Something really interesting to note here is that over the course of the hearing, Capri shares rose from $35 a share to $42, moving closer to that $57 merger number. So that shows that you know, people had been really optimistic that the deal would actually come through.
Alex, you know, I don't believe in mergers.
You don't
There's no such
in
thing as a merger.
Or sales.
That's true. That's
he likes to know very directly what the power dynamics
are.
There's
always an underdog.
Anyways, there's other things moving markets as well. Earnings in particular. What are you watching?
Yeah, Coursera is an interesting one. Shares are plunging this morning after they issued disappointing guidance and also said that they would cut 10% of their workforce. Now, what's interesting with this company is typically we see that often when we hear announcements about headcount declines, that's typically a sign that a company is trying to improve its profitability. We tend to see the stock move higher. But here, investors are focused on that disappointing guidance, which has been a big theme for the last two earnings quarters as people try to see, you know, what's ahead for corporate America.
I noticed there was a story the other day about Denny's, right? And we said that consumers were moving down to the kids' meals to save money. But I was also thinking it could be because of portion sizes, right? If you go into a restaurant and you get something that's so big, there's no way you can ever finish it.
GLP-1s that are causing you to downsize?
I mean, maybe, right? If I can get a hold of some GLP-1s, I'm gonna be shooting myself up right away. And yeah, exactly. But anyway, the stock is moving.
Yeah, the stock is lower today. You know, obviously we've been talking a lot about earnings, but this is actually due to analyst downgrades. Citi and KeyBank cited greater cost discipline. Sorry, the stock is rising. They cited a greater cost discipline and accelerated accelerated store closures. So interesting reaction here, given most stocks have been moving on earnings.
Did you have a Denny's? Was there a Denny's in Paramus? Because where I lived in Ohio, that was the place to be at like 4 o'clock in the morning for a
We
big
did
breakfast.
Applebee's, but yeah.
Applebee's is not a 24-hour place, though.
All right, we stayed there late. Anyways, next week is an even bigger week for earnings. What are you looking at?
Obviously, it's all about big tech next week. They've been powering those stocks, the S&P 500 rally since last year now, but we're seeing, tremendous profit growth profits slowing tremendously from last year. Going into this quarter, we're expecting earnings growth of 18% year over year compared to 40% last year. So a lot of the luster coming off of these big tech names, and obviously a big theme last quarter was that some of the laggards were outperforming. The equal-weighted S&P 500 outperformed. So it'll be a really crucial moment for big tech. Will the cap-weighted index go higher, or will we see some sectors like utilities and energy start to catch up to that trade?
Alex, we thank you so very much for keeping an eye on all of it for us. We'll talk a lot more about that in the show. Of course, big week ahead.
And we're going to talk about those tech-concentrated ETFs later on as well.
We sure are. Of course, some of them are hella levered, aren't they? Anyways, coming up, more on Tapestry, Capri, and Lena Khan's big win. We're going to take a look at what the M&A landscape could look like in the next administration. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Time now for high interest to look at what's making headlines around the world. Microsoft CEO Satya Nadella received a pay package worth $79 million for fiscal 2024. That's a 63% rise from his pay the year before. Around 90% of that, though, is in Microsoft stock. Nadella's pay would have been around $5 million higher if he hadn't asked for a pay cut to reflect his personal accountability for changes the company is making to reflect cybersecurity risks. This according to a regulatory filing. Anyway, the guy is getting paid a ton of money, but creating a lot of value for shareholders as well. Lenders to Dish Network told attorneys for DirecTV that its current proposal for a merger, which calls for those creditors to swallow $1.6 billion in losses, is unworkable. DirecTV rejected a counteroffer from that group of bondholders, which proposed adjusting a debt exchange that the merger will be contingent on. They told DirecTV you can negotiate, close the deal as it is, and pay a premium or face more litigation. And we've been talking about how a federal judge blocked the planned $8.5 billion acquisition by Tapestry of rival Capri. It's a major victory for the FTC, which has said it would be harmful to competition in the handbag market, and you know how important that is. The decision caught markets off guard. A lot of observers here of the hearing had predicted the FTC was more likely to lose the case, but Shanali, the handbag market for now has been kept safe.
Absolutely. You have to make sure that of all the dangers in the world, those handbags in particular stay away from any danger. Anyways, for more on what the regulatory landscape could be under the next presidential administration, we are joined now by our antitrust analyst, Justin Teresi of Bloomberg Intelligence. And clear win here for Lina Khan, but wondering, there has been so much pushback against kind of these anti-merger sentiments coming out of the FTC. Does this one win mean that the direction of travel is very clear for the future of antitrust and deal stopping when it comes to just worries about competition among industries?
Hey, Sonali, thanks so much for having me. So, you know, I really think that this is a huge issue with the election here. And I think no matter who wins in a couple of weeks, I think that's really going to define what we see now for the future of enforcement and M&A kind of review, if you will, at the FTC. I think, and really, no matter which candidate is victorious next month, I think chances are Lina Khan might be on the line here in terms of being reappointed for a second term. There's a lot of pressure from the left for Harris to keep her if she wins, but at the end of the day, I think that the whole idea of a president having their own view and their own staff really across their cabinet suggests to us that she might not be reappointed, as some folks are pressuring Harris to do.
In terms of Lina Khan's ability to stay on, Justin, we know J.D. Vance, famously a fan, but would Donald Trump keep her on? Is there agreement on that ticket in terms of this kind of FTC enforcement?
So I think on that particular point, the answer from our view is a resounding no. I think that even though J.D. Vance has really been out there and has expressed some level of support for Lina Khan, at the end of the day, Donald Trump is very unlikely to appoint her simply for the fact that I think she could be seen as kind of rogue in the action she would take at FTC. And Donald Trump already went through a bad experience during his last term with his FTC chair, Joe Simons, who he saw as not particularly loyal to him either. So I think all of that kind of in the stew here with what the next administration looks like, I think it's very unlikely, no matter whatever the level of fandom might be for Lina Khan, that both candidates really take a hard look and probably don't reappoint her in their term.
How do you feel about the way the FTC has been using their power in this administration? You know, one thing that was interesting in the commercial break, me and Matt were kind of talking about where the Chevron doctrine really applies here, and where there will be kind of erosion of that after the Supreme Court hearing. And you made this great point that that really implies more to the rulemaking, not the enforcement, correct?
Right. But I will say, you know, while Chevron really relates to rulemaking at the federal agencies and how they go about setting, you know, these rules that, you know, regulations that we all kind of live by, what is happening is that the kind of aggressive stance that FTC has taken lately, and this involves things like the suit they recently brought against pharmacy benefit managers and the mergers that they're choosing to block, what it is doing is inviting these lawsuits that involve a constitutional challenge to the FTC's own internal administrative tribunal, right? So with every one of these lawsuits that might be brought by the FTC, it's interesting to see how that plays out in terms of courts' review of whether or not their internal tribunal is actually constitutional. At some point, you know, looking at courts like the Fifth Circuit, we could see a situation where that actually, the constitutionality of their own internal review process really ends up on the line as well.
Justin, great to have you here, and it's awesome that we have such a great bench of legal and regulatory experts from Bloomberg Intelligence. So thanks so much for joining us. Justin Teresi there of BI talking to us about the FTC and what it's going to look like in the next administration. depending obviously on who wins, right?
What I think is fascinating when it comes to deals in particular, there are some sentiments that both parties really adhere to. You think U.S. Steel, for example. Of course, both parties have been
protectionist.
Totally. And
Yeah.
then when it comes down to big tech, you have to wonder whether big tech could get bigger under either administration. So there is some overlap, but clearly a deal like this might be more likely in the future.
Yeah. Might be more likely in the future, right?
A lot of questions.
Yeah, there are, and some of them will be resolved in just about 11 days. Coming up, the E. coli contamination fallout continues as Taco Bell, KFC, and Burger King pull onions from some of their locations. Social climbers next. This is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
And it's time now for Social Climbers, the companies making waves this morning. First up, Yum Brands and Burger King are removing onions from some of their locations as the restaurant industry investigates an E. coli outbreak first traced to McDonald's. Yum withdrew from onions from some Taco Bell, Pizza Hut, and KFC locations out of an abundance of caution, according to the company. Next, Morgan Stanley choosing Ted Pick to be its next chair, succeeding James Gorman, who was tapped to head the Walt Disney board, but Gorman will step down as executive chair of Morgan Stanley at the end of the year. Finally, Deckers Outdoors getting a head start today after reporting second quarter results that beat estimates and boosting its sales for the full year ahead. The maker of UGG boots and Hoka running shoes is capitalized on its popularity among teens as competitors like Nike continue to struggle. You can follow all the latest company buzz on TRNG Go on your Bloomberg terminal. Matt, are you buying those Uggs this season?
I don't. Well, definitely not. But you have kind of a hippie vibe today. Which
Oh yeah, this is what I do. Cowboy boots in the summer, Uggs in the winter. They're coming.
I like it. All right, we're going to come back with a look at these markets. Futures up. This is Bloomberg.
this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, you know, we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, you know, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
We are moments away from the start of trading on this Friday, October the 25th. This is Bloomberg Open Interest. I'm Matt Miller. You do see green arrows on futures right now, just 1/3 of 1%, a little more on the S&P 500. We're down right now almost 1% for the week. So we'd have to really put up some serious gains in order to finish this week in the green. So we likely won't, right? It'll be the first down week in the last 7 sessions. But I don't want to bum you out. OFG Bancorp, along with 60 Años Oriental, ringing the bell at the New York Stock Exchange. There's a biotech company, Septerna, at the NASDAQ market site. In terms of the major averages, again, we're going to see gains today, but not enough to bring us back to positive for the week. I guess we had a pretty good weekly run anyway. 6 weeks of gains, 30 days without 2 back-to-back losing sessions until the beginning of this week. NASDAQ doing better than the S&P as tech stocks continue to power higher right now, up 0.7 of 1%. And the small caps are doing okay as well, up 0.6 of 1% right now. The question is how those small caps fare if we start to price out Fed cuts. I'm going to talk to John Stoltzfus from Oppenheimer about that in just a moment. Shanali?
Don't count out the small caps. There are a couple stocks on the surface we're keeping an eye on as well. We're going to watch shares of Tesla shedding some gains here. Remember, they were just flying a day ago after rallying 20%. CEO Elon Musk said the EV maker is poised for sales growth of up to 30% next year. Now, Tesla only down about 1%, so nothing to cry home about after what we saw yesterday. Bring back up Capri and Tapestry. Remember, we were talking about that U.S. judge blocking the proposed $8 billion merger. The judge cited competition in the accessible luxury handbag market, but you're seeing different reactions. Tapestry's actually up about 10%. Capri down still more than 45% as the market opens. It's a good day to be a sneaker company, though. Also taking a look here at Deckers, the company behind Hoka and UGG, surging here after boosting its sales. You have Deckers up almost 11%. Skechers also boosted its outlook, and On Holdings is higher after the sector news today. On is up almost 3.8%. Skechers fluctuating, but up about 0.4 of 1%, Matt.
All right, let's bring in Oppenheimer's chief investment strategist, John Stoltzfus, joins us now here on set. Great to have you in the studio, John. What do you think about the Fed continuing to cut rates? I mean, everybody seems to have that penciled in, but we're looking at 3.4% in terms of GDP growth. Earnings are beating expectations. Stocks are at an all-time high. Corporate spreads are at tights. Why?
Well, you know, Matt, I think what it is they are really focusing on the other half of their dual mandate, and they really want to make sure that the full employment rate stays intact. So around 4%, somewhere. Nowadays, it's between 3 and 4%. They want to, if it's 4.1, 4.2, that right away tells them they have to be careful.
I mean, the average has got to be much closer to 5.
Yeah, it probably does. But the current situation would say that Powell very much wants to avoid a situation where he would find a flashback in terms of inflation. But at the same time, he wants to avoid, as companies looking ahead are now beginning to more and more, you hear it all the time, whether it's technology, reducing the employee base or selective groups within the sectors. When that happens, they just don't, and then you have the hurricanes that have happened, the storms. So I think we could get 2 cuts by the end of the year, if and as needed. So first it's as needed and it's if needed. They may just avoid cuts at all.
Well, that's the thing. Is it needed? Because you saw the earnings story, and many companies are actually holding up very, very well.
Sure.
And if you look at the past week, it's actually consumer discretionary that performed better than anything else.
Isn't it wonderful? You know, that's one of my favorite sectors because it's been an underperformer this year. And we always say, don't bet against the American consumer because the resilience is extraordinary.
People forget that.
Yeah.
Every cycle, people forget.
Every cycle.
People are worried about the consumer weakening at this part of the cycle. What is the risk that you do see weakness heading into next year?
Well, I think the risk that we really see is beyond next year. But the most important thing we think is once we know what the outcome of the election is in all 3 houses, the White House, Congress, the House, and the Senate, at that point, the market will have an idea. But even more important is once you're beyond Inauguration Day, you've got a year that's almost, there's some kind of a honeymoon that usually happens. Think back to 2017, and then think back to 2021, were honeymoon years for the president who had just been inaugurated. But then in the year that follows the inauguration is when the rubber meets the road and you get an idea what the policy changes actually are, what has been able to pass through Congress. So we'd almost think that we got a pretty, 25 may prove to be a pretty good year when we look at it because it will be election resolved. Let's see what happens. Most important is the environment still one in which revenue growth and profit growth can continue, and you can see resilience in job postings, even at a slower pace based on all the hikes that occurred this hike cycle. So we remain positive on this thing.
I mean, I go back to the consumer, and I go back to Harley Davidson. They cut their sales outlook 14 to 16 to a drop of 14 to 16%.
$50,000 per bike.
Well, those are for the CVOs. That's just the bikes I want, right? But even a regular bike, a regular Harley, you could pick up for new for 15 grand, right? And this is, I think, the sort of quartile of the consumer that we're a little bit worried about. If you're not buying bikes, then if you're not buying Harleys, then you're strapped, right?
Well, you know, I think the issue really is it's that the consumer diversifies their spending and they go for perhaps experiential things that may be a short trip to see a friend. Or they may go to discount stores, or they may buy private label. But that's the most important thing that and then the balance sheets, both of the consumer and business, this cycle have been extraordinary. Some of that, by the way, I believe it's because the financial news segment of our journalism tends to be so good at getting the message out that people are actually more sophisticated today. And the market and the consumer is just better educated.
You know, I want to go back to what you were talking about the election. Election night. What are you going to be watching for? Is it the S&P? Is it the dollar? Is it the bond market? What is going to be the clearest
What are the assets on your dashboard, John?
Oh, I'm overweight equities at this point. I'm considerably underweight fixed income, but that's generally our position. I'm an equity guy. But I am cyclicals over defensives here. Favorite sectors include information technology, communications services, which has the traditional telcos, but it's also got, of course, the search engines. It's got social media, and it also has as well.
But I mean, if you were in financial news, right? If we're like, hey, John, we need you to put on an election night special for us, and the graphics people said, John, which Which assets do you want to have up here when the results start coming in? What are you watching?
I'd say what I'd be watching would be primarily Congress, and then I would also be watching, of course, the presidential election. But the most important thing is
bonds. Would you put up currencies? Is the dollar?
I'd have them all up on my screen. I've got, I go everywhere from short-term treasuries right on through commodities, currencies, sectors, market capitalization, style, and believe in broad diversification. Because I also, like I said, aside from those two sectors, consumer discretionary, industrials, and financials, because those are the things that touch the economy and the population the most, really. Healthcare, it does also, but healthcare's got political problems, both sides of the aisle, in terms of how to deal with profitability.
It's interesting, and you're not the only one that's told us that they'll be watching so much that night. And my question is this because you've seen such an aggressive Trump trade put on into the days of the election? If he doesn't win, do those drastically unwind? And is there a Harris trade put on instead?
I'd say invariably you would see some kind of unwind, but I think that the trade is not so directional as it might appear to at first glance. I think if you look at the rallies that we've seen this year, it's broad diversification. It includes both cyclicals and defensives. The smalls and the mids are getting to play a role here. And as a result of that, we think a lot of the population within the market today it really is represented, we'd have to say, not just by fear and greed and the action of the moment, but genuine need, whether it's to put a kid through college, whether it's preparing for a retirement in a world in which Social Security is no longer to play as big a role as it did, and defined benefit programs are long distant in the rearview mirror. We think there's reason to believe that the actual structure of the market is intermediate to longer term related, and people have become accustomed at the support they get by a Federal Reserve that has been remarkably sensitive in applying its dual mandate.
Addicted is a word some would use. Addicted is a word, rather than accustomed, no?
I would hope not addicted. I think addicted gives it the shock value, Matt. But I would say, it depends. When we speak with investors, we've been really big. It's not about buying the dip, but about catching the babies that get chucked out with the bathwater when the traders throw everything down like a hot potato on some kind of a catalyst that appears that lets them sell without FOMO in the midst of a big bull market.
John, awesome having you in the studio. Hope you come back and visit us. John Stoltzfus there from Oppenheimer. Coming up, Apple is cut by KeyBank on fears of unrealistic expectations ahead of earnings. Details on that and more in Top Calls next. This is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It is time now for our top call, some of the analysts' action in focus this morning. First up is KeyBank, as we told you before the break, cutting Apple to a sell. The firm says the tech giant has unrealistic expectations for growth, and its valuation is too high. Apple reports earnings on October 31st. You can see investors not troubled really by that call right now, up a third of 1% at 231 and change. Next up, Citi is upgrading Denny's to a buy. The firm says the breakfast chain is getting better at controlling costs, and it is closing stores. Denny's announced earlier this week it would close 150 restaurants and slim down its menu. The stock is up right now almost 6%. Finally, Jefferies says Boston Beer is no longer a buy, downgrading the brewer to a hold. The firm says it thought beer and cider sales would improve over the summer, but instead the numbers got worse, and other growth avenues are limited for Boston Beer. You can see the shares are down now almost 5%, 288.19. Sonali?
Sadness. Not enough pumpkin spice beer. Anyways, the latest IMF Global Financial Stability Report says near-term financial stability risks have remained contained, but there are vulnerabilities from lofty asset valuations and climbing debt. We're going to discuss this with Tobias Adrian, IMF Director of the Monetary and Capital Markets Department. You know, I want to kind of hone right in here on a specific part of your report, and that surrounds the non-banks. Obviously, a lot of attention, but this market has been growing rapidly, particularly this year. If you had to bring it down to the single biggest issue when it comes to what you're watching around the burgeoning non-bank system, what would that be?
Yeah, so let me start by pointing out that U.S. capital markets are foundational for global capital markets, and the bond markets, both treasury and corporate bond markets, are very important for the U.S. economy and the global economy, hence our focus on that segment. So what we're watching particularly carefully is, you know, on the one hand, the easy financial conditions, credit spreads are very tight, but on the other hand, we have seen episodes of sell-offs, and we try to very carefully assess to what extent there could be further such vulnerabilities.
Well, when you think about those vulnerabilities, another part of your report that touches on a part of the market that is considered liquid but may have liquidity mismatches, it's bond fund ETFs and mutual funds. When it comes to the specific concerns there, obviously you've seen significant inflows with the rate cutting cycle and where spreads have been. What is your concern here?
Yeah, so what we're looking at in the report are leveraged bond funds, so both leveraged mutual funds and levered ETFs. And what we are seeing is that those levered funds tend to have more capital inflows and outflows at risk. So it's not just that they are levered, so have more maturity and liquidity transformation, but they also have more flow volatility. So we're watching closely to what extent those are stabilizing or potentially amplifying market moves in certain conditions.
Hey, Tobias, back on August 5th, which seems like a lifetime ago now, we had a little bit of Volmageddon, and markets dropped on concern that the carry trade was going to be unwound, or maybe because it was going to be unwound. I know it's hard to measure, but it's something that we spent many weeks talking about. Is that a risk looking ahead?
Well, when we look at the carry trade itself, there was certainly an unwind, but it was fairly orderly. Exchange rate moved, but it was not in a disorderly fashion. We did see a sell-off in equity markets and implied volatility spiked, both in the US and in Japan. But markets were able to absorb the shock and really rebounded very quickly. So I think it was a big move, but then there was also a very quick reversion. So there were sellers and there were buyers. So on net, the outcome is positive. But of course, it's something we are watching closely. And we are looking at various angles to really make sure that global financial stability continues to be sound.
At the end of the day, it's interesting because the Federal Reserve, in its own stress testing of the banks this year, did include hedge fund leverage as part of their assessment, not the critical assessment, but in other parts of their assessment. So when it comes down to your analysis, are you more concerned about the hedge fund industry or actually that of private credit, given how much you have seen the industry grow, attract interest from big institutional investors and retail investors? Tobias, if I think you're worried about bond funds, how would you feel about private credit wrapped up into an ETF?
Yeah, so from a policy angle, we really try to get a very comprehensive picture where there are pockets of leverage and maturity transformation. We did a deep dive into private credit recently. It continues to be a relatively small market in the overall credit markets, but it is growing quickly. And of course, cumulative returns have been strong. So we could expect there to be further inflows. But from our visibility, the degree of leverage and maturity transformation continues to be contained. Now, it is, of course, important for the banks and the dealers to manage exposure to private markets, private credit markets, and hedge funds carefully. And so looking at both the infrastructure and market functioning issues, as well as the counterparty credit risk management issues, remains key to assure financial stability.
Tobias, we thank you so very much for joining us this week. Of course, that is Tobias Adrian of the IMF, off of their very closely watched financial stability report. Now, coming up, more in the world of finance, Wall Street's favorite new tool, tax loss harvesting. It was interesting before and ever more interesting in the future. We're going to give you details on why next in our Wall Street Beat. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's time now for the Wall Street Beat. We're looking at today's big take. So many Bloomberg things to keep an eye on. Wealthy investors are using tax-aware long-short strategies to generate losses. Those losses can then be used to offset capital gains taxes, allowing investors to minimize their tax bills. Here with more is Bloomberg's Justina Lee. And, you know, part of me wants you to go into the nuances of how this is working at this juncture and why it's taking off. I mean, the numbers in your story are stunning. But first, I think we have to just kind of talk about what's at stake here and how this would work if Kamala Harris were to win the election, because it wouldn't work the same way, would it? Yeah, that was
right, exactly.
I don't think Kamala has made it clear, right? That what I got from your story, and we're talking about whether or not she would tax unrealized gains. She hasn't said that. I mean, I read that, I thought, in multiple parts of your story.
Yeah, that's right. And I think that was kind of a pretty big controversy at the time, because she said that she would support President Biden's earlier budget plan, which did include a minimum tax that would tax unrealized gains on billionaires. But more recently, when we asked her campaign, they've kind of declined to give a lot of specifics on that. And I think that really is the core here, because for the longest time, taxpayers, they have the option to choose, to sell their losing investments, to defer selling their gains, which kind of means that you don't have to pay your capital gains tax bill as your wealth grows. And I think that's pretty controversial for a lot of people who are very worried about income inequality, but that's just has always been how the tax code works.
And to be clear, we are not clear on her strategy, to your point.
No, we're not. And when we talk to even Democratic donors, when we talk to Alan Patrikoff, he's like, I'm not worried about it. It's never going to happen. And come on, this is America. That's terribly unlikely to happen. That's the kind of thing that they do in France, but not here. To me, the interesting thing is you can offset so much in terms of your capital gains. You talked to Cliff Asness of AQR, at least you looked at some of his strategies and found with big money, you get really big returns, right?
Yeah, and it's actually pretty neat, because I think a lot of people are familiar with, basic tax loss harvesting, where you're trying to just sell your losing investments to offset your gains from elsewhere. But the problem with that is a lot of the time, with investments going up over time, you just run out of things to kind of, tax loss harvest on. But the good thing about kind of longs and shorts is you're using leverage, and you have these shorts, which are bearish bets. And so it kind of means that, no matter where the market goes, you will always have losses kind of on your portfolio somewhere, even if generally your portfolio is still making money.
I would say it's one of the best stories I've read on the Bloomberg in a long time, Justina. And there's a ton to choose from. So congratulations on the story. I'll recommend to viewers, just go to Bloomberg.com and check out the story. Wall Street takes tax loss harvesting to a powerful new level. It's an incredibly good read, but you really have to pay attention and figure out the mechanics behind it.
You do. Read it twice even. But look at this. The S&P 500 is even higher than we started the market day, up 0.7%. We'll bring you more markets soon. This is Open Interest. Stick with us.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. This is the Bloomberg Intelligence Radio program. John Tucker sitting in for Alex Steele. Alex is out today, but John's sitting in for the next couple hours, so we are in good hands. Coming up, we're going to check in with Joanne Su, University of Michigan. She's got some of that data coming out of the UMich that Lisa Mateo is going to break in just a moment. We're also going to talk to Joel Levington, Bloomberg Intelligence Global Director of Credit Research. He follows the auto industry from the credit perspective. He's got some research out on Mercedes-Benz. They're talking about cutting costs because China is a tough market for the European and the U.S. auto manufacturers. Victoria Fernandez, Chief Market Strategist across Global Investments. She's going to join us, give her thoughts on these markets coming up. So we got a lot coming up. Let's go to Lisa Mateo. She will kick it all off with a Bloomberg Business Flash. Lisa.
And Market Drivers brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost, global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. All right, you mentioned the data, so let's get right to it. 70.5, that was higher than the prior. The prior was at 68.9. Paul and John, they're going to break that down with a guest in just a minute. Some more economic data, though. Factory orders for durable goods, they dropped for a second month in September, declining commercial aircraft orders. That offset an increase in business equipment. All right, we have green on the screen. We're closing out a busy week of earnings. Today we heard from Colgate-Palmolive. Their shares right now down 3%, despite it reporting a third quarter earnings beat. You have New York Community Bank Corp. They're down 8%. Guidance for net interest income, earnings per share, 2024, 2025. They were below what Wall Street expected. And I have to go to Capital One. Their shares right now, they are up 7%, and it posted a profit, beat Wall Street estimates, strengthened its credit card and auto lending business. So we have the Nasdaq up more than 1%, 255 points, the Dow Dow up 0.4%, 187 points. The S&P 500 up 0.8%, 49 points. Finally, the two-year yield, 4.03%, down 4 basis points. A yield on the 10-year, 4.18%, and that's down 2 basis points. That is your Bloomberg Business Flash. Back to you, John and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. John, looking at that UMich data, a little bit better than expected. And what's also interesting to me is the one-year inflation outlook. The consensus was 2.9%. Came in 2.7%, so maybe people feeling a little bit better about inflation.
And of course, this is the pulse that we take just before the election, the last one before the election.
Great point.
So we're going to have to put on our politics hats as well.
Yeah, exactly. Let's break this data down with Joanne Shu. She is Surveys of Consumers Director at the University of Michigan. Joanne, it seems like some pretty solid numbers here. What is your takeaway?
Hi, I'm here.
Okay, there we go.
Can you hear me?
Perfect, yes.
Yes. Over the last few months, consumers have been inching up in their level of confidence in the economy. They haven't really been seeing major swings up or down. A lot of people are kind of reserving judgment until the election because for a lot of people, the trajectory of the economy depends on which candidate wins the presidential race.
But what does it say about their feelings about which way they're going to vote? Because the economy, we're told time and time again, is the #1 issue.
You know, consumers overall are feeling much better about the economy than they were 2 years ago. Business conditions, expectations are near their historical or at their historical average. So people are not feeling as dismal about the economy as they did a year ago, 2 years ago. At the same time, they continue to tell us how much high prices are weighing on their personal finances. So people don't necessarily feel like they're thriving now, but they really have seen quite a bit of improvement since the peak of inflation a couple of years ago.
Joanne, how much, if any, is the recent Fed rate cut factor into these results?
For consumers, they're absolutely expecting, they welcomed the rate cuts. And when we ask people about buying conditions for large purchases like cars or homes or durable goods, those have all improved on the wake of these rate cuts and continue. Consumers expect that to continue going forward. We have over half of consumers expecting further rate cuts in the year ahead. So it is helping a little bit. It's not helping dramatically. Home buying conditions still near historic lows, but consumers absolutely welcome these rate cuts.
Hey, before you go, who are the people that you survey? Are they whacked out lefties or hardcore right-wingers?
All of the above. We get a random sample of American consumers. We get all ages, all political stripes, all educational attainment levels, and it absolutely comes through in our data.
All right, Joanne, thank you so much for joining us. Always appreciate checking in with you on these UMich days. Joanne Shu, she's Surveys of Consumers Director at the University of Michigan. All right, folks. What would you like to hear on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg Audience Survey. Visit youtube.com/Bloomberg Podcast and click the link in our profile or community section to take the survey, which is hosted by our partners over at Material. Fill it out now at youtube.com/podcast. Looking at the markets here, they seem to like some of the economic data, looking for a little bit stronger end to a week, which has been a little dicey for these markets. We got the S&P up 0.8%, and the NASDAQ up 1.3%, and the Russell up about 0.5%. Let's check in with Carmen Reineke. She covers all the equity markets for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker Studio. Carmen, what are you looking at today?
Yeah, so what I'm looking at this morning, one of the first things is Tapestry. So shares of Tapestry are up about 14% right now. A federal judge.
Do you think Carmen knows who Carole King is?
No.
Do you? Not off the top of my head.
Great album.
Here's just a little homework assignment when you go back to your desk.
Okay.
Carole King, Tapestry, Google.
Will do.
And then I will suggest listen to it this weekend.
Will do.
Okay.
So a federal judge blocked the company's $8.5 billion acquisition of Capri Holdings. So this was a major victory for the U.S. Federal Trade Commission. They're saying that the merger would be harm to competition in the accessible luxury handbag market.
What is that? Do you know? Is it just like those little bags that the ladies in Park Avenue carry? Okay.
I think it's about the price point, right? So it's bags that are, like a couple $100s, not a couple $1,000s.
This is
so
the competition the regulators are worried about.
I can't believe this.
I didn't know that this was so contested.
I tell you what, if you want to do an M&A deal today, John and Carmen, I mean, you have to make sure it is locked down, can get approved, because they're blocking everything these days. It seems like they're really looking very harshly. A lot of these deals, the airline industry, accessible handbag industry, which I didn't know was a thing.
I mean, don't they? Can you check with the regulators first before you even propose a deal like this?
You pay some very high-priced attorneys in New York City to say, hey, before we announce this deal, can it get approved? It's just, and I think the world's changed. I think the world's changed over the last 3 or 4 years. So we see this, the Department of Justice, the Federal Trade Commission, they're getting looking at a lot of these deals a lot more closely. So that's interesting. And the stocks are moving on that news today.
Yeah, exactly. And so Capri is down 47%, worst drop ever. The companies plan to appeal the action or the decision. And so shares of other companies that are potentially in mergers were also moving on this. I know last night I was looking at Albertsons and Kroger. So any kind of deal, you're right, totally under more scrutiny now.
I'm looking at this. I mean, the shareholder value being destroyed here is just amazing. And I think about these regulators. But again, if you're thinking about doing a deal, you better really make sure it's locked down from the regulatory perspective before you move forward. What else are you looking at? Yeah,
so also looking at HCA Healthcare. This is ticker HCA. Shares are down about 10%. It's the worst drop in about a year for the company. It's a hospital owner. Earnings were less than analysts expected. The thing that I thought was interesting here was that the company said that it expects its full year results likely in the lower half of the range provided because of the impacts of Helene and Milton. Those two hurricanes hit facilities in North Carolina, Georgia, and Florida. And there were other hospital peers. Tenet Healthcare and Universal Health Services were also down on this news. So just seeing the impact of the weather that we've had here on these hospital companies.
We're also waiting for the impact of the elections on some of these companies because the different administration would extend the Obamacare subsidies, which is very important for them.
Yeah, that's true. I mean, there's just a lot going on, I think, in healthcare that
always. And I tell you what, I've studied it my entire life, but I'm not afraid to say I have zero comprehension of healthcare economics and healthcare finance. I just don't know who pays who. I don't know what happens. My bill comes in and I don't know who's paying everybody. I look at the little bottom line at the end. What do I owe? And that's kind of what I just deal with.
Also how I feel about insurance.
Yes, there you go. All right.
The last one I'm looking at, Deckers. So I love talking about running shoes. Shares are up 11%. I'm a runner. 2 weeks to the New York City Marathon.
You're running in the marathon?
No, I'm not running the marathon. Not this one.
Okay.
But shares are up actually now 13%. It's the biggest jump since July. Sales of Hoka running shoes and UGG boots in the second quarter were what lifted sales here. It helped boost the forecast for the full year. Wall Street has really cheered this. They say that Deckers is operating in the bullseye. That's a quote from Barclays. Hoka in the early stages of global growth. A Piper Sandler analyst also said that this has a positive read-through for On Holding, which is
Hokas
another
are a thing. I'm not a Hoka person on it, but I see them around all the time.
No idea what that
They're
is.
so
It's
popular.
sandwich.
No.
What are your running shoes?
Yeah, what are you running?
I actually am very consistently in Asics, and I've run in them since high school, but I like the Hokas. I've yet to try the Ons. Fun fact, both of my parents are podiatrists, so
so you
lots
know,
of running,
the
lots
feet
of
thing.
shoes.
Okay.
Yeah.
Interesting. All right, interesting stuff. Deckers Outdoor stocks moving higher after they boost their sales forecast. Carmen Reinecke, thank you so much. We appreciate that. Good stuff. Trump 2.0 haunts world economy chiefs in Washington before vote. Whoever wrote that headline, that's a great headline. That grabbed me. I started reading it. We've got the IMF, down in D.C., all the economic heads from folks around the world. Topic number one is the election, because that's obviously going to be a key driver for the global economy over the next several years. Eric Martin joins us, Bloomberg International Economics reporter. Eric, what did you hear from the world's economic leaders down in Washington, D.C. this week?
Well, of course, there are all of the topics that are on the official agenda in terms of inflation, debt, growth. But really, the topic that has taken a lot of oxygen out of the room has been the U.S. election. Talking to visiting officials who'd say that a lot of things could change in 11 days, 12 days here. And so, that's kind of, at one point I said to someone visiting, this is the 10,000-pound gorilla in the room. They said, no, I think it's 100,000 pounds. And so, it's looming over this entire process. These meetings are normally the focus of and the biggest event of the financial year for economic policymakers globally, kind of the economic and financial Super Bowl, but certainly taking place in the shadow of this election contest on November 5th.
Eric, they say one thing when they're, being recorded or whatever on TV or on radio, for the record. But you're a good reporter, and you go to the bars afterwards and hang out with these folks. What are they saying? What are they saying when they're not being recorded?
Sure. Well, I think, potentially a drink or two into the evening after the conversations of the day have wrapped up, people talk about the concern that particularly if former President Trump returns to the White House, that their perceptions about U.S. leadership in the world could change, expecting an administration that could act much more unilaterally rather than multilaterally. We saw in the beginning of the Biden administration a big effort to repair and to fortify the alliances and cooperation with the rest of the G7, with Europe. And if you contrast that with, for example, President Trump's experience complaining about the G7 and about Canada after one of the meetings there during his administration, one of the leaders' meetings, and just the expectation that the U.S. might have a much more go-it-alone strategy towards dealing with a lot of the challenges that we currently have officials from almost 200 countries here together in Washington trying to solve together and collaboratively. So really expecting, if President Trump is elected, a very different kind of approach and culture coming from 1600 Pennsylvania Avenue, just a few blocks down from where these meetings are happening.
Yeah, exactly. So, have you heard any strategies from some of these folks? If, in fact, we get a second Trump presidency, any strategies about how they may want to try to adapt here? Or is it just kind of a wait and see and react to what may come out of a new White House?
Sure. I spoke with the finance minister of Pakistan on Tuesday. He was talking about his nation's work with administrations, both Democrat and Republican, in the past, and a need to kind of redouble efforts there. I spoke yesterday with Ajay Banga, who was nominated to be World Bank president by President Biden, but talking about a hope and an expectation that President Trump, if he is the winner of the election, would see the value in the World Bank's ability to leverage the money that comes to it, either fourfold or tenfold in the depending on the context of the lending. So certainly everyone realizing this is a very close election, an expectation that if Kamala Harris, the vice president, wins, there could be more potential for continuity there. And certainly a lot of policymakers hoping for that and hoping for that kind of collaborative approach, but everyone also preparing themselves for what could be, more of a chaotic or a disruptive U.S. presence on the world stage in Trump 2.0.
Are they mentioning Ukraine at all and the impact on Europe?
Certainly there's some focus around Ukraine and what kind of support the U.S. would or would not give to the Zelensky administration in terms of its relationship with Russia. What happens in Ukraine and the longevity or the timing of the war has big implications, including in financial markets, financial world, on Ukraine's debt situation, Ukraine being one of the biggest IMF borrowers at the moment. So certainly a lot of focus there, as well as what the continued conflict in Israel and Gaza means in terms of potential to cause commodity price spikes. So a lot of financial repercussions from what we see on the geopolitical stage.
Eric, thanks so much for joining us. That's Eric Martin. He's international economic reporter for Bloomberg News, joining us from Washington, D.C. The IMF was there this week, so we had a lot of the world's economic leaders there. And again, John, as Eric was saying, that it's not so much some of the mundane economic matters that they typically focus on, traditional ones, I should say, but it's more on the election. And how do you deal with that uncertainty? From
uncertainty and volatility at this point. Which begs a quote for the VIX. VIX right now, 1833. So it's a
It is actually amazing that the VIX isn't materially higher, I would say. Not just higher, but materially higher. It seems to me. But, I mean, here we are. But we got, a strong day in the markets here to finish off the week here. We're starting the morning trading session pretty strong. S&P 500 up about 0.8%. The Nasdaq's up 1.25%. And the Russell up about 0.6%. Yields coming down just slightly. 10-year Treasury is off a couple of basis points, 4.19%. So we keep that in mind. Call out gold steady, 27.36. WTI crude oil a little bit higher here today. We got it up about 1.3%, $71.10 for WTI crude oil. Call out the Bitcoin for Tom Keene and for Matt Miller. It's up about 0.5%. Bitcoin 68,000. Call it 400 right there. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks ending off the week on a positive note. This is after a solid reading on consumer sentiment, which actually rose to a 6-month high. Big tech leading the gains ahead of next week's results. Right now, we have the Nasdaq up 1%, 254 points. We have the Dow up 0.4%, 167 points. The S&P 500 up 0.8%, or 48 points. Also, this New York Stock Exchange announcing it's extending trading on its ARCA equities venue to 22 hours on weekdays. Over to the bond market, the 2-year yield 4.04%. That's down 3 basis points. The yield on the 10-year 4.19%. That's down 1 basis point. Over to commodities, we have Brent crude $75 a barrel, WTI crude $71 a barrel. We have spot gold at $2,736 an ounce. Pointing out Bitcoin up 0.6% at around 68,000. Few stocks on the move. It's Capri Holding right now. It's down 47%. That federal judge blocked its planned $8.5 billion takeover of its retail rival Tapestry. Speaking of which, Tapestry up 14%. Spirit Airlines up 25% now. Word that it plans to sell planes worth about $500 million to help boost cash. It's nearing a possible bankruptcy filing. And finally, a quick check of Boeing shares as those workers' strike drags on. They focus on pensions now. Boeing shares up about 0.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and John.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out over there. One of the stories out of the global auto business, John, has just been the weakness in China. You've got the consumer a little bit weaker there, so that's hurting all the international automakers in China. But then you've also got the growth of the domestic electric vehicles in China. They have some real
But was Tesla
brands.
immune to that? I'm still trying
No,
to
it's
figure that
interesting.
out.
I think Tesla's had some challenges, although their latest deliveries were pretty good. But all these global automakers have to deal with a weaker China, particularly some of the European ones who really have a big presence there. Joel Levington joins us. He's the Global Director of Credit Research at Bloomberg Intelligence, and his research coverage includes the credit of the global automakers. Joel, talk to us about Mercedes-Benz. I mean, talk about a global auto brand that just got cachet all over the world, but even Mercedes-Benz is not immune to some of the challenges in China. What are you seeing there?
Yeah, no, you're totally right, Paul, and thank you for having me. Yeah, I mean, with Mercedes, I think the question with them is, even though they're luxury and they should be viewed as luxury for a good reason, like the average car costs about $81,000 here. But luxury doesn't mean immune from affordability, and that's really the real issue. And if you look at the results today, their unit volume was just down 1%, but profitability was down 48%, and that's largely on pricing, which really tells you that autos and luxury kind of means something, but it's not the same thing as like a bottle of Moet or other, like high-end goods like at Burberry. And it's really showing up not only in the pricing of the cars, but also in the captive finance companies, the financing units of these companies, where you're seeing net charge-offs rise for a 10th straight quarter. So it's telling you something about even the high-end luxury good consumer starting to face more challenges than they did just a couple of years ago.
Is Mercedes getting a jolt from electric?
Well, they're getting a jolt in the trunk. It's really hurting their profitability, and you can see it in their margins. Mercedes tends to be in the 10 to 12% operating profit margin range. They were 4.7% for the third quarter, so really cutting it down. So when you see sales down 7%, but profitability down 50%, you could see just the high amount of operating leverage that inherent in this company, and that's largely based on like the EVs. They have write-downs in their business, and really like in the U.S., like you could look at an EQS, which is a $100,000 plus car. Right now, Edmunds.com is saying that you can get discounts of over 12% on a $110,000 vehicle. So it just kind of shows you just how bad that business is, and that's pure profit when you're discounting.
Joel, for the big European names like a Mercedes-Benz, like a Volkswagen, how big is China for them? It just feels like it's obviously much bigger than it is for the U.S. companies who really aren't there, but how big of a business is that for them?
Yeah, well, China is about 15 to 20% of sales for Mercedes, but really it's the mix where you're having a high-end mix. And I think that's really some of the change is that you're seeing the Chinese making really high quality premium products with great tech in them at a fraction of the cost. And it's really like, how do you think about brand value in China for some of these European names, which don't have the longevity as they do in Europe? So whereas my colleague Mike Dean does studies that will tell you a European isn't necessarily ready to go into a Chinese car, the Chinese are much more open to brand switching. And that's really penalizing some of the European names, especially if you have tariffs thrown on top of that. The price differential is pretty significant.
So, Joel, in response, Mercedes has to cut. Where are they going to cut?
Yeah, well, they're cutting in pricing, but really what the Europeans and the U.S. companies will eventually have to do is rethink about their cost structures, where they want to be, both regionally and in terms of the componentry in their cars. Like, do they need to make everything? Should they outsource more? Should they find other components to, cut expenses? I think one of the easiest ways, John, to reduce expense is to limit the amount of variance of a car. With an Explorer, for example, they had over 1,000 different versions of it that you could buy a few years ago. They've narrowed that down to 80. But I think what you're going to see is kind of going back to the Ford Model T days, where you can get a choice of, you can get it in black or you can get it in white, like whatever you want. And I think by doing that, you're really scaling up your ability to produce quickly and efficiently. Right. And I think that's really where you're going to have to take out, a lot of cost.
Yep. I mean, John, I got the 2024 BMW, first new car I bought in 10 years. The leap in all the stuff that's in the car, all the electronics, all the tech is unbelievable. I feel like I'm driving around in an iPhone with 4 wheels.
But with all that extra stuff, is that more things can go wrong.
Exactly right. And the more things that go wrong, they can't just kind of pop it and replace it. They got to get it like a technician and go through it. It's a scam. But anyway, I'm like everybody else. I fall for it. Joel Levington, Global Director of Credit Research at Bloomberg Intelligence, joining us here. Let's step back and take a look at these broader markets here. We do have some green on the screen here today. We got the S&P up 50 points. That's 0.9%. The tech-heavy NASDAQ up about 1.5% here. So that's good news there. Victoria Fernandez joins us. She's a chief market strategist at Crossmark Global Investments. Victoria, we had some pretty good economic data today. I know durable goods orders came in better than expected. We had the UMich sentiment survey come in better than expected. If I'm the Federal Reserve, I can actually think about maybe I don't have to cut come November. How do you guys think about it over there at Crossmark?
It's really been our thought process all along that we would only get 2 cuts from the September through the December meetings. We thought we would get a 25 basis point cut in September. They would skip November, and then we would get another 25 in December. For the exact reasons that you're talking about, we've seen some of the growth components of the economy continue to do pretty well. I mean, you look back at the end of August, the city economic surprise index was one of the worst levels it's been in years, but it has come up significantly since then. It's one of the reasons we've seen 10-year Treasury yields come up because they have a pretty high correlation. So I think it does give the Fed a little bit of wiggle room if they don't want to do anything the week of the election, because I have a feeling we probably won't know who the president is come Fed Day when they're ready to have their press conference. It gives them a little bit of cover to hold off and then maybe do another cut in December.
Did we get ahead of ourselves by the markets by pricing Fed cuts?
I think we absolutely did. It's no different than at the end of last year when the market was pricing in, 6, 7 rate cuts by March. And we were having the conversation with clients going, there's no way that we're going to do that. The Fed has worked too hard and too long to get us to the point where we are. They're not going to start cutting that quickly. And we saw the market reprice at that point in time. They did the same thing here. I think they thought, okay, we're going to hit September. Labor market is weakening. We had that one payroll report, was it July, that really kind of unnerved the market a little bit. And the markets just ran with that. And again, here we are pricing some of those cuts out. You look at where the neutral rate is priced. A couple months ago, that neutral rate was around 2 3/4, 2.5. Now we're back up over 3. We're closer to like a 3.6. So they basically cut in half the number of cuts that they're expecting over the next 12, 18 months. So yes, I think the market got a little bit ahead of itself. It's correcting itself now, which again plays into the Fed's hand of being able to be a little more cautious.
Victoria, we're kind of in the teeth of the earnings season right now. We've had, obviously, the big banks put out some really good numbers last week, and we're starting to see some more. What do you make of this earnings season here so far, and what do you think the market needs from earnings this period?
So we saw expectations get really lowered, right, coming in to this earnings season. It's really the lowest earnings growth season that we've had since the second quarter of 23, so a little bit over a year. And it was negative back then. We're not expecting anything negative here, but you're looking at maybe 3 to 4% earnings growth for the third quarter. And you might say, okay, we're starting to see things come through from a weakening labor market. Maybe we start to see less hiring, wages are cooling off, margins are being compressed. All of that would make sense to see a lower earnings bar being set. But right going into next quarter and into the 4 quarters of next year, expectations are right back for double digits. So it seems like the market thinks earnings are continuing to be strong. Obviously, I don't have a crystal ball to tell us whether they will or not, but if they don't, then I don't know how we support a 22 times valuation on the equity market. So earnings better pull through if we want to see the stock market continue on the trend that it's been on.
All right, so what should I buy? How do we position ourselves?
So the one thing we don't want to do is get in the way of the momentum of the market. And we know we have this kind of momentum play going right now because you're seeing yields and stocks, except for the last couple days, yields and stocks have been trending higher together. But we do think you need to be a little bit guarded because there are yellow flags that are out there, whether it's, JOLTS report, whether it's temporary hiring declining, whether it's hiring rates across the board declining, all of these different kind of yellow flags we've been seeing in the economy. So we want to have a pretty balanced portfolio. We like financials because of the yield curve we think will be re-steepening. They've gone, as you've mentioned, they had really good earnings, so they've gone up. Maybe wait for a little pullback. Industrials are showing leadership right now versus the rest of the market. But find some of those areas that have pulled back as of late. Healthcare, staples, even some of the tech names. That's where I think you need to go in and start looking. You look at a name like Cigna that we own, doesn't have exposure to Medicare and Medicaid like some of the other HMOs and has been holding its own, but it's had a pullback. You can go in there. And even a name like Qualcomm, I think within the tech industry, we know we've got the Mag 7 reporting next week. You can find some other areas within tech to add some exposure. So make sure you're diversified, and we would add a little bit of fixed income to have steady cash flow with yields as high as they are right now.
All right, Victoria, thank you so much for joining us. Victoria Fernandez, folks, she's Chief Market Strategist at Crossmark Global Investments, joining us via Zoom from Houston, Texas. She's a Houston native, born and raised in Houston, went undergraduate school at Rice, which is one of the great universities in this country. Wish I looked at Rice back then. I didn't even think about that. That would have been such a cool thing to be in Houston, Texas at Rice. Didn't even think about it. All right, we'll try it again next time around. More coming up.
There's going to be a next time.
Yeah, oh, yeah, there's going to be a next time. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They are all very much in the green. This Bloomberg Business Flash is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about our consultative support and technology. Stocks ending the week on a positive note. Potentially might see another up week. Right now we have got the S&P on the week down by 0.1%, but stocks higher today after a strong reading on consumer sentiment roughly 40 minutes ago. Big tech leading gains ahead of next week's results. Apple reports next week. Bonds continue to stabilize after a recent surge in yields. Right now the S&P is up 50, back at 5860, a gain of 0.9%. Dow Industrials up 170, up 0.4. The Nasdaq Composite Index up 267, up 1.5%. And the Russell 2000 Index of small cap shares up now by about 0.7%. 10-year 4.20%, with the 2-year that's yielding 4.05%. Gold little changed, up $1 the ounce to $27.37, and West Texas Intermediate crude now up 1.5%, 71.21 a barrel. So again, recapping, stocks higher, S&P up 50, up 0.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pella, thank you so much. We appreciate that. John Tucker is sitting in for Alex Steele. I'm Paul Sweeney. We're live on the Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Coming up in just a minute, John, we're going to do a simulcast with Bloomberg Television. We're going to Deutsche Bank CEO Christian Saving speaks with Bloomberg's TV anchor Lisa Abramowitz. You know, you look at Deutsche Bank, you know, and all these European banks. Can they be? How relevant can they be in a global world where you got J.P. Morgan and Bank of America and Goldman Sachs and Morgan Stanley? It seems like they need to consolidate over in Europe.
And specific to Germany, though, could Deutsche Bank conceivably be a white knight, you know, to fend off Commerzbank, specific to Unicredit?
Possibly. I mean, I kind of think, you know, if there were to be some consolidation, you could see some winners there potentially on a global scale. Deutsche Bank, UBS, Barclays, but in the current world order, they've been kind of left behind. So let's see what Mr. Saving has to say. Deutsche Bank CEO Christian Saving speaking with a Bloomberg Television anchor, Lisa Abramowitz, on the future of the leading German lender. Let's take a listen right now.
Hey, how's it going, Matt? Yeah, I am here with Christian Saving, who's CEO and chair of Deutsche Bank, Germany's biggest lender here in Washington, D.C. for the IIF, the IMF, the IRF, and everything else under the sun. Christian, thank you so much for being here. It's really a treat to speak with you. And I want to go over a couple of the big themes that we see this week. The U.S. election, the growing divide between U.S. and European economies, and geopolitical risks. And I want to start with the U.S. election. How different is it between U.S. and European bank officials when they talk about the U.S. election?
I think there is not so much difference. Obviously, we are all observing it. I mean, we had a year of elections throughout the world. Half of the world's population went to elections. So obviously, everybody is focused on this one. I think from a European or German point of view, it is in particular, we are all focusing on what happens and what is the impact on the economic development, and in particular with regard to trade and tariff. And in this regard, there is obviously a lot of discussions in Europe. I'm always telling my clients, irrespective of the outcome, we all need to take into account that we have seen so many changes from a geopolitical point of view over the last 5 to 6 years, that we need to adapt either way. And it means that actually Europe needs to work on its home market. We need to make sure that our home market is becoming bigger, that we are really living one home market in Europe in order to be actually strong enough to compete with the US. Maybe that under President Trump, obviously from a tariff point of view, the situation will be even more challenging for European corporates, but we need to take the right steps right now. We need to prepare, and therefore, you know, not only watching, but making sure that we adapt. I think that is the right solution, and that is the advice we as a bank give to our clients.
Do you see any signs that there is a willingness or ability of people, particularly in Germany, to adapt at a time where there's a real question about the main industry, which is auto manufacturing and competition from China?
Look, it looks potentially from the outside that there is no willingness and that the urgency is not understood. But I can tell you the willingness and also the understanding is clearly there. And obviously reports like the Draghi report, but also the Letter report earlier this year are helping. Now, we have a complicated system in Europe with 27 member states. And obviously it takes time. But I would say that the understanding in Europe that we need to move, that we need to rethink the way we are defining our European home market, that we need to think about what can we do about energy prices, being competitive in this regard, that we need to think about actually reducing bureaucracies in order to allow investments. And finally, and in this regard, I'm actually quite optimistic, the tone when you think about also the financial industry, the criticality of the financial industry, that capital markets union is now on top of the agenda of Brussels, but also of the main European countries, tells me that the message is understood. Of course, we all wish that we execute quicker.
Okay, so let's go there. You're talking about the unification of a financial union at the same time that there was a lot of dissent from German regulators about the idea of UniCredit buying Commerzbank, and a real question about whether that could go through. Do you think that there is a necessity for consolidation in the European banking sector in order for that strength to really happen?
In general, I think yes, there is. And we always said that. I have said that for the last 6 years, that if we think about the European banking environment and the banking industry, we are kind of overbanked. If you think about what is really needed when we think about the future, lots of investments into technology. If you think about the regulatory environment, I do believe that scale is important. But we also always said, from a Deutsche Bank point of view, first of all, some preconditions also on the regulatory side needs to be done. Sometimes at these, or in where we are right now, sort of say consolidation is not that easy from a regulatory point of view, where we stand, not finalized banking union and so on. And from a Deutsche Bank point of view, we always said, look, we have a clear strategy for 2025. We want to increase our return on equity, and we are on a very good way to above 10%. And therefore, we are focusing on ourselves. But industry-wide, it must come, and it will come over the next years.
Do you think, though, that there would be a much bigger competitive advantage for Deutsche Bank to be a bigger bank, especially when facing off with the JP Morgans and the Bank of Americas and the Citigroups of the world?
Well, first of all, I'm very proud that in those businesses where we are today, we can face off also the American banks. And we have a good market share. If you think about the FIG business and the investment banking and the corporate bank, honestly, we are among the top banks. And I'm really proud where we focus on, we are among the leaders. And, you know, it's all a matter of time. But for the time being and for the next years, Deutsche Bank has such a potential to grow its profitability by itself, to grow and look from where we're coming. I took over the bank with 24 billion of revenues. Now we are heading 30 billion revenues in 2024. We reduced the cost. Why shall I look outside if I can do the next steps on my own? That's my whole focus. You know, I'm not talking about the years after the next years, but for the time being, only focus on ourselves.
In the recent earnings that you just reported, right before flying out to Washington, D.C., you reported a 42% gain on revenue, which is fantastic, quarter over quarter. You also increased provisions for loan losses, and this was on commercial mortgage debt and a whole host of other assets. A lot of people are tying this to some of the slowdown that we've seen in the German economy. Do you think that's accurate?
No, I think we need to be very precise when it comes to the loan loss provision of Deutsche Bank. First of all, to be honest, I think we are still a bank with a very low risk profile. Our loan loss provisions are, over the last year, somewhere between 25 and 30 to 35 basis points. If you compare that internationally and globally, it really shows that it's a low risk profile. Now, there are 2 or 3 specific reasons why we have shown an increased loan loss provisions in Q3. We still have some impacts from the backlog situation on the Postbank integration. that will go away. Actually, we will even see some reversals of loan loss provisions in 2025. Then there is, a little bit more complex items that for one or two exposures, actually, we had hedges in place, but we needed to build the gross loan loss provision. But we got the hedge income via the revenue stream. So on a net basis, very much controlled. And on commercial real estate, to be honest, we saw in the third quarter, for the first time, I'm really happy about that, a reduction in loan loss provision. So we think we have seen the peak. Valuations are coming back. Obviously, reducing interest rates are helping. To be honest, I think Deutsche Bank has seen the peak of loan loss provisions in the third quarter from a quarterly number. I'm very, very confident in our risk management. I've done that for 25 years in this bank, so I think I know the book, so I have no doubts.
I think people are not as concerned about some sort of existential risk to Deutsche Bank or anything like that. The concern is really, where is growth going to come from? Because right now, the German economy is not showing it, and you're seeing actually a contraction. And you're seeing concern about businesses, about how much production can be absorbed given some of the lack of spending. How do you grow? Do you move outside of Germany? Do you increase your exposure to places like Italy and Spain and France and the US? Or is there still an opportunity?
Well, there are a lot of opportunities, and that was always the reason, Lisa, why we decided as Deutsche Bank to be a global bank. I love my home country. We have approximately 38 or 39% of our revenues in Germany. But I think it is so important in this world, which we are experienced, to be globally diversified. And the advantage of that we are seeing right now. Our growth rates in Asia, in particular playing also the European-Asian bridge, are really nice. And the momentum I see, it is simply growing. We have a nice business in the US. We're doing almost 20% of our revenues in the US. We are not offering each and everything in the US, but there where we are offering, we're actually even gaining market share, which is good. And then, look, we always said we want to be the global house bank to our corporate and private clients. In particular, in a time of uncertainty, of geopolitical uncertainty, you cannot imagine how many clients are coming back to us and are asking for our advice with regard to changing their networks, making sure that they are diversified, opening other markets. And there we can help. And therefore, the situation, as challenging as it is for a global house bank like Deutsche Bank, is actually an opportunity to advise their clients in this challenging situation. And that's what we are seeing. The momentum of the revenue side, very positive.
How much more are you seeing that from clients looking to diversify where they are or move away from certain countries?
It's a constant theme. I would say it's a constant theme since approximately 2 or 3 years. Of course, the COVID situation, but also the awful invasion of Russia into Ukraine have really, in my view, sharpened the risk management muscle of our corporate clients, and they are thinking far more about diversification than ever before. And in this regard, they are looking actually for a bank with a global exposure, with a network in over 60 countries. And therefore, it's a constant theme which we have seen for the last 2 years, and actually it is still further growing.
What region is the best for you, or the one that you're focused on for expansion?
Well, from expansion, I would say there is a lot of activity actually in Asia. Also there, if you think about the diversification there, I will always said it's not about decoupling from China. It's all about diversifying. And we can see a lot of momentum actually and action happening in actually diversifying business opportunities from our corporate clients within Asia. Going to outside of China, going to India, going to the southeast of Asia. That is the reason why we are in more than 17 markets in Asia. So that is clearly a growth market. Don't underestimate the Middle East. I think it is for the next years, it's a growth market. We invested heavily on the private wealth management side, but in particular also in the investment bank on the Middle East. And then from a product point of view, we took, actually 18 months ago, we took the clear decision to grow our fee business in the origination and advisory business, because we always thought at some point in time, net interest income will reach its peak. We need to increase our fee business. That combined with the advisory needs of our clients is a real opportunity that we want to be strong in.
Christian Sewing, thank you so much for being with us. That's Christian Sewing of Deutsche Bank. Back to you.
All right, that was Bloomberg's television anchor Lisa Bromwitz down there in Washington, D.C., speaking with Deutsche Bank's CEO Kristen Saving, talking about the future of that bank as a European player and as a global player as well. Again, it seems like maybe the worst is behind Deutsche Bank, and now they can focus on growth as they think about net interest income and their fee income.
And he didn't sound too interested in Commerce Bank, did he?
It did not, but
I think he used the phrase "by ourselves" or "by itself."
Yeah, but I think, you know, like a lot of the big European CEOs, very open to having the opportunity to do some cross-border deals. So we'll see if that ever comes into play over there. Here, closer to home in financial services, Capital One Financial, they reported some better than expected numbers. The stock's up 8.7% today. It's up 27% year to date. That is a 52-week high. Let's break down the numbers with Ben Elliott. He covers all the banks for Bloomberg Intelligence. Ben, the market liked what they heard today. What did you see in Capital One's results?
Yeah, so it's a pretty bullish earnings call. You know, everything's going in the right direction. Loan growth is up, provisions are down, credit's sort of performing as anticipated. There's a little bit of a sort of idiosyncrasy in this earnings with the termination of an agreement they had with Walmart. So that kind of boosted some of their numbers. But I think a lot of this response is optimism looking forward to when they can close the deal with Discover and start sort of migrating some of their volume to their own payment rails.
This is a true story. You know how you get those credit card solicitations? Sure. My cat got, it was addressed, I swear to God, it was addressed to Raffy Tucker from Capital One. Who are their customers? Because Raffy was definitely subprime.
So yeah, Capital One's a little more exposed to subprime. That's actually where their expertise really lies. You can see that in the big yields in their credit card portfolio. They have about 30% subprime below 660 FICO customers, and the rest are above that. Of course, that's kind of a little bit of a low cutoff. One of the big effects of the pandemic and all the stimulus and liquidity is that FICO scores sort of migrated up across the board. So that led some other lenders to kind of make a few mistakes in their lending and see their charge-offs go higher. But by and large, Capital One avoided that, and they've been kind of reaping the rewards, as you can see in the price action today.
You mentioned Discover Financial. I guess I'm looking at your research, looking for an early 2025 close. Discover Financial is a huge company. I mean, this has got to be transformative for Capital One. Talk to us about that transaction and what you expect to come from the combination of those two companies.
Yeah, it's big. It's a little bit over $100 billion in loans, and that will sort of tie in very nicely into Capital One's portfolio from a sort of FICO average kind of borrower perspective. But by far the bigger and more transformative sort of part of the transaction is they're going to get their own payment rail. So they're hoping by 2027 to move $175 billion of volume, mostly on the debit side, over to Discover. And so that gives them a lot more ability to negotiate with merchants, to provide better value to their customers, and to reap more of the economics instead of sharing it with, you know, the Visas and the MasterCards of the world.
How'd that one get by the goalies? Anyway.
That's a great question.
Hey, one of the things that it looks like they do, like nobody else can, is use customer data. How's that going?
Yeah, I mean, so they're notoriously tight-lipped about that, but obviously that's a gigantic part of their business. They're kind of the original fintech, the CEO and founder likes to say. And so you kind of have to look through at the KPIs, and I think sort of one of the most interesting ones is the credit performance that we talked about. So, you know, you saw some other sort of subprime card lenders get up to, you know, 6, 7, 8% net charge-offs, and Capital One has kept it pretty tight around 5.5%. So that translates directly into yield and into margin, and makes their business serving the same customers inherently more profitable.
Hey, Ben, thanks for joining us. Really appreciate getting a few minutes of your time. Ben Elliott, he's a consumer finance analyst for Bloomberg Intelligence, working from the Boston offices, lonely looking down in, well, not a lot of company down there in the Washington D.C.
By the way, Raffy did not get the card. She did not.
She died.
She also died. But
okay, well, yeah, we won't talk about that. Yeah, Capital One, good numbers today. Again, stock up 8.5%, up 26% year to date, hitting a 52-week high. On a trailing 12-month basis, stock's up 87%. Not bad for a credit card company. They have some good ads, I have to admit. They kind of, what's in your wallet, that whole thing kind of sticks with you.
Jennifer Garner, right?
Yeah.
Is that the one?
Yeah, I'd watch whatever she's in, I'd watch. So, but I mean, it works, you know, I don't know. Good numbers coming out of them. S&P 500 up 43 points. The NASDAQ up 244 points. That's 1.3%. Green on the screen. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Vince Signorello, Bloomberg's market strategist, get his thoughts. What is he hearing from traders on Wall Street today? Nathan Dean, Bloomberg Intelligence senior policy analyst. He's down in Washington, D.C. And folks, when it comes to all the stuff, legislative stuff coming out of D.C., he is our go-to guy. So get a sense what's happening down there in D.C. 11 days before the election. It is Friday. That means we talk municipal bonds. Matt Miller and Alex Steele's favorite topic. They love municipal bonds. That's coming up today. Justina Lee, Bloomberg Cross Asset reporter, also on the big take story. Wall Street takes tax loss harvesting to next level, getting a ton of readership on the Bloomberg terminal. Right now, let's kick everything off this hour with Mr. Charlie Pellet.
All right, I thank you very much, Paul Sweeney. Lots of great guests coming up, some of the smartest names in the business. Got to keep it locked into Bloomberg Radio. We are brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about our consultative support and technology. Stocks wrapping up the week on a positive note. Could see a record out of NASDAQ today, surging 249 points, up 1.4%. 18,665 where the NASDAQ Composite Index stands. The NASDAQ 100 Index up by 1.4%. Full of those big tech names, including Apple, Amazon, Meta Platforms. They all report next week. S&P up 46, up 0.8%. The Dow right now up 124, up by about 0.3%. Bottom line here, we do have big tech leading gains. 10-year 4.20%, with the 2-year 4.05%. Gold up $1 the ounce to $27.37, up less than 0.1%. And West Texas Intermediate crude back above 70 today, 70.88, up by just about 1%. Sentiment among American consumers increased in October to a 6-month high as households grew more upbeat about buying conditions, partly because of cheaper financing costs. Joanne Shu is Director of Surveys at the University of Michigan, and she was a guest right here on Bloomberg Intelligence.
You know, consumers overall are feeling much better about the economy than they were 2 years ago. Business conditions, expectations are near their historical or at their historical average. So people are not feeling as dismal about the economy as they did a year ago, 2 years ago.
Joanne Shu of the University of Michigan, interviewed right here on Bloomberg Intelligence. Capri Holdings shares are now plunging 47% after a federal judge blocked the planned $8.5 billion acquisition by Tapestry. That is the maker of Coach, Kate Spade handbags. Capri's brands include Michael Kors, Versace, and Jimmy Choo. Right now, again, that Capri worth repeating down 47%. Tapestry, though, surging 15%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Yeah, I think I'm with Charlie Pellet here. I don't think that word consultative, I don't like it. I'm not even sure it's even a word.
Why use it?
It trips you up every time you read it. I'm just not. I'm going to think of another word here. I'm going to go to my thesaurus, see what I can do here. Charlie Pellet, thank you so much. We appreciate it. We got John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We are live in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube.com, so head over there and check us out. Search Bloomberg Podcast. Green on the screen here. Got a pretty solid day here. We'll hand it off to Carol Master and Tim Stenovic in the afternoon and see if they can hold on to these gains here. Vince Signorello, He joins us here. He's a Bloomberg macro strategist for Bloomberg News. And John, I'm not sure if you know, but the Bloomberg New York HQ, the global headquarters here, we have a satellite office. It's up there in White Plains, and that's kind of where we have Vince Signorella. Vince, thanks so much for joining us here. We got some green on the screen here, maybe a little bit of risk on here. What are you hearing from your trader buddies around the street today?
This looks like actually just a little bit of profit taking after a pretty rough week for the markets. A lot of focus, obviously, on the elections and what that means for treasuries and interest rates and how that's going to translate back down to the Fed. I think we'll probably see a little bit more risk off going into the week next week, heading with just about 1 week to the elections as we get into next week. It's just traders pairing positions. Nobody wants to go into this in a big way. But the interesting thing about that, I think, which is not really being talked about too much, is I think once the election is settled, when we know, because some of the states are going to be delayed, but once that's decided, traders are going to be jumping back into it again. So we're probably going to see a lot of activity, a lot of volume, and probably a lot of volatility the days that are following the election.
Can I ask you, Vince, real quick, what is the signal that the bond market has been sending to the equity market? Is this about politics? Is it about the economy? Is it about the data?
I think it's all of those things, John. I think, number one, the politics of it, when you have the markets betting, as you look at the betting sites, having Trump like 62 to 38% as the winner of the election. He's talking about tariffs. He's talking about tax cuts. A lot of things that basically would drive rates higher. The economy in and of itself, look at the jobs market, it's strong. And basically the Treasury market is saying to the Fed, whoa, or as Carol would say, whoa, you're moving a little too quickly. There's a real potential for inflation to come back up again. And so that's, I think that's where we stand at the moment.
Vince, where's the market these days, do you think, on this Federal Reserve and where they'll move? We had some more pretty solid economic data today in terms of, the University of Michigan. We had some industrial production and, obviously the retail sales from last week. The economic data looks pretty solid. What do you think the rates market is telling you and the currency market's telling you about the Fed?
Well, I think the rates market's basically just saying the data is, as you just mentioned, solid. If you look at UMich today, kind of a Goldilocks situation. Expectations up, sentiment up, and 1-year inflation expectations dropped to 2.7 from 2.9%. So that's really positive for the economic outlook. And you have to remember we're heading into the holiday season. Look at UPS earnings just the other day. Basically saying the consumer is strong. I think their stock was up 5% after earnings. And hiring is still strong going into the holiday season. So I think we're not looking at recession. We're not looking at any of those situations, at least for this year. Maybe next quarter, in the first quarter of next year, when things dial down as they usually do. But I think as we head into the end of October, we're going into, as I said, the holiday season. Just don't see the data. I don't see the data basically saying to the Fed that they should be in a hurry.
I'm going to return to the Treasury market, sorry, but do you see any risks of liquidity with respect to the Treasury markets?
People keep talking about that, but I honestly just don't see where that's coming from. You look at distressed debt and distressed credit. There's a lot of liquidity, a lot of demand for those products. So I just don't see why you wouldn't see it for treasuries if you're seeing it in areas that you should see liquidity risk. I mean, the curves are relatively steady. There's no pressure. There's no pressure on the curves, which suggests a liquidity risk. The dollar is relatively steady, so we're not seeing that massive haven flow. The only places I see any kind of liquidity risk actually are in metals, maybe gold.
You mentioned the dollar, Vince. I'm just looking at the Bloomberg Dollar Index. We kind of, bounced off that low back in, I guess, late September, and the dollar's rallied a little bit. Are we kind of range bound with this dollar, do you think, or where's some of the money going with the FX?
I think as we go into the election, it's just going to be a little bit of a shake, rattle, roll kind of thing. But I will say this: it's not really being talked about too much either. If Trump is elected and he does go down the tariff road, there's a lot of people who think the dollar will weaken, and I would be contrary to that. I think if you're an exporting country into the United States, and there is some potential tariffs being put on your goods, your only answer to that is to devalue your currency, and that means a stronger dollar. So I think when you look at countries that export into the United States, China, Japan, Europe, even Canada and Mexico, for instance, which no one's really talking about. South Korea may be the canary in the coal mine, watching their currency. If there are tariffs imposed on goods coming into this country, I think you're going to see a stronger dollar because you're going to see devaluation in currencies, countries whose currencies need to devalue to make up for those tariffs.
All right, Vince, thanks so much for joining us there. As always, Vince Signorella, he's Bloomberg macro strategist for Bloomberg News, joining us via Zoom up there in the satellite global headquarters for Bloomberg there in Waitlist. Exactly, but he's happy, he's comfortable. All right, it's all about the election, John. It's all about D.C. The good news for us is we got Bloomberg intelligence people down in D.C., and their job is to figure out what's going to happen in D.C., in Congress, and how's it going to impact various industries and various markets. We actually pay them to do this stuff, and they're really, really good at it. Nathan Dean is our go-to person on all things Washington. He makes sense out of it all. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, joins us here. Hey, Nathan, I'm sure you're getting this question 1,000 times a day. What will a Harris administration look like, and what will a Trump administration look like across basically everything, and how will it impact the markets? How do you kind of synthesize that question to our clients?
Yeah, so I think we're saying that there's 4, maybe 5 key themes. Let's go with 5 for next year in terms of a Harris or a Trump presidency. And you can see where both presidencies are going to have to play out in these themes. The first is, like you just mentioned, tariffs. Now, we have a 70% chance of tariffs coming no matter what next year. It's just whether or not they are a broad tariff, like 60% on all goods coming from China, or a subsector tariff like what we've seen in the Biden administration with on automobiles, for example. Tariffs are somewhat popular, so tariffs are coming. The second is tax. The Trump-era tax cuts expires at the end of 2025 for individuals. So we're going to see a robust tax debate. And specifically, you're going to see a debate on whether or not that corporate tax rate changes from 21% to something else to help pay for these tax cuts. You're going to see a regulation effort or a deregulation effort, depending on who you are. This is certainly important to the investment banks. You're going to see the debt ceiling return probably in the second to third quarter next year. You're going to see a debt ceiling fight if Kamala Harris wins the presidency. And finally, a lot of people have questions on the Inflation Reduction Act because there's a lot of CapEx coming into the United States on renewable industry, for example. Will the IRA either be cemented under Harris presidency or tweaked or altered to help pay for those tax cuts under a Trump presidency?
For banks, I go right to the capital requirements under Basel III. How do the candidates stand on that, and how would that impact the sector?
Yeah, so you're talking about the Basel III endgame. It's a proposed rule which, if outlined as by the Fed, would increase capital requirements for the American GSIBs. So think of the Bank of Americas, the JP Morgans, and the Citigroups, around 9%. You're looking at around a 3 to 4% increase in terms of the mid-sized regionals like PNC Truist. Now, if Kamala Harris wins the presidency, we think this proposal will be reproposed in the early part of next year, and they'll try and finalize it towards the end of 2025, maybe the beginning of 2026, and then implementation would begin the next 3 years after that, or over the next 3 years. If President Trump wins, I think you're going to see the work on this just stop. And I don't think these capital requirements are ever going to be implemented, at least not within the next few years. And this is where it could actually turn global in terms of its impact. The European regulators have already implemented this. They call it Basel IV. It's already been implemented. And we've seen steps, for example, in the UK for the UK regulators to delay the implementation because they're concerned the Americans are never going to follow suit. So if the American regulators say, no, we're not going to move forward with the Basel III endgame under the Trump presidency, you could see the potential start of a global race to the bottom in terms of capital as Europe begins to actually pull back some of their stuff as well.
Nathan, you're down there in D.C. You're knee-deep in this stuff, and I know you got great sources down there. Is there any consensus to how Congress may play out in this election, or House is flipping? Are they staying the same, or are we going to have a split type of thing? Is there any consensus?
Yeah, so I think most Washingtonians think that the Republicans have a really good shot of taking the Senate. And the reason being is that this is not a good race for the Democrats. They're defending 23 against 34 in states in total. And with Senator Joe Manchin retiring in West Virginia, most likely going to replace him with a Republican, you know, the Democrats are essentially going to have to run the gauntlet and have a really good night in order to keep the Senate. Now, why do we care about this? because the Senate there's a filibuster in the Senate for legislation. There's no filibuster for nominations. So if Kamala Harris wins and the Senate Republicans take the Senate, they'll effectively be able to jam a lot of her nominees, a lot of her regulatory leadership in place for the first half of the year. If President Trump wins, he's going to be able to get a lot of his nominees in place and be able to move much quicker on a deregulatory effort. Now, when it comes to the House, polling is a little bit more difficult. It's extremely tight. Our general thought is that whoever wins the presidency will most likely win the House. And the reason why investors should care about who wins the House is because of the tax debate that I mentioned next year. Tax policy historically starts in the House. So whoever controls the House Ways and Means Committee, and therefore controls a very important person in Washington who's going to decide what those tax negotiations will look like next year.
Can I just jump back to some of the sectors, specifically with electric vehicles? Harris, they would support subsidies for electric vehicles or tax breaks, which I find curious because Elon Musk is the guy stumping for Donald Trump at this point, and he stands to be, well, Tesla stands to be impacted quite a bit by this.
Yeah, we've heard anecdotally that, because Tesla, the Tesla vehicle is pretty expensive. And so whether or not a $7,500 tax credit would change the buying habits over Tesla. I've been talking to our autos analyst, Steve Mann, about this quite a bit. So there's some thought out there that Tesla is somewhat protected. We've also seen through Steve's work that some of the other automakers are looking to try and put out low-cost EVs as a way to combat that. But the reason why the EV tax credit is so important is because it's part of the Inflation Reduction Act. And if you're going to try and figure out how to pay for $3.5–4 trillion worth of tax cuts to extend those, the IRA is certainly something they're going to be looking at. Now, I think the IRA, for most part, is going to be cemented. It's really popular in Republican states in terms of that CapEx that's coming in and building plants. But that EV tax credit is one of those provisions that could potentially be on the chopping block to help pay for those tax cuts.
John, if I were elected president, my first phone call would be, get this Nathan Dean guy in my White House just to get stuff done. He knows everything, and I feel like he knows everybody, and he just explains stuff so well and just gets stuff done.
Why isn't anybody talking about the fiscal deficits at this point? Because I guess it's just, it's
not good
impolite.
politics.
They're not popular.
It's not good politics. All right, hey, Nathan, thanks so much for joining us. As always, Nathan Dean, we're going to be tapping into him basically on a daily basis going forward. Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence, the only one in D.C. that I can understand and when he's talking about all this stuff going along. Hey, folks, what would you like to hear on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg audience survey. Visit youtube.com/Bloomberg Podcast and click the link in our profile or community section to take the survey, which is hosted by our partners over at Material. Fill it out now at youtube.com/Bloomberg Podcast. And a pretty solid trading day here in the market. We've got some green on the screen after kind of a rough 3 or 4 days. Got the S&P up 0.7%, the NASDAQ up 1.4%. 10-year Treasury yields off just slightly, 4.19%. Looking at WTI crude oil, that's a little bit higher today, up about 1%, just under $71 per barrel. Gold, $2,740 per ounce. It's up a couple of bucks here today in Bitcoin, up 0.5%, just about $68,500. We're going to have more coming up. We're going to break down some more earnings coming out of a global Wall Street. That's coming up in just a moment. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg, and we begin with the latest from the CDC on McDonald's and the E. coli outbreak. The CDC says the outbreak of E. coli linked to McDonald's burgers has now spread to 13 states and infected 75 people. That is up from 10 states and 49 on Tuesday. CDC says the true number of sick people in this outbreak is likely much higher than the number reported, and the outbreak may not be limited to the states with known illnesses. McDonald's shares now trading lower by 1.8%. This on a day when stocks are advancing. Stocks are finishing the week on a positive note after a strong reading on consumer sentiment. Big tech is surging. We begin with NASDAQ up 259 points, up 1.4%. NASDAQ 100 index up now also by 1.4%. To put that in context, S&P up 40, up 0.7. The Dow little changed, up less than 0.1%, higher now by 21 points. 10-year 4.19%, the 2-year 4.05%. Gold up $4.50 the ounce, up 0.2%, 27.40, and West Texas Intermediate crude is rallying 1.4%, 71.19 a barrel. After earnings, Capital One Financial shares are surging 7.9%. It posted a profit that beat Wall Street estimates. Capital One seeking to acquire rival Discover Financial Services, DFS, advancing by 7.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by Build America Mutual. BAM Mutual insures municipal bonds that finance essential infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM.
BAM.
Insured bonds.
Come on,
there you
Nick.
go. Kids, we're all in. John, I'm not sure if you knew this. The longest running football rivalry in the South is my University of Richmond Spiders against the Tribe of William and Mary.
No way.
Yes, yes way.
I
So it's
actually
not
didn't know they
Alabama,
had football
Auburn.
teams,
It's
but-
not Georgia, Florida. It's Richmond and William and Mary. They're only about 40 minutes away from each other down there in Virginia. Nick Corello joins us. He's a municipal finance reporter for Bloomberg News, a proud graduate of William and Mary, and he's covering the muni space. John, start us off with San Francisco. You just were telling me something there.
Yeah, they were downgraded, their debt. I mean, it's still investment grade, but what happened?
Yeah, I mean, the reason for this downgrade was really interesting to us. San Francisco was cut from a pristine AAA rating by Moody's down one notch. Again, not a huge upgrade, still very, very highly rated security, but Moody's cited a weaker economy because of depressed commercial real estate values in the technology hub. And
Are we going to go out and we're going to blame people not going back to the office 5 days a week in San Francisco?
I totally am.
It seems like that's a big part of it. I mean, we look at the Castle data that kind of tracks workers badging into the office, and San Francisco is really lagging a lot of its peers. Their recovery, they're still 40% of what they were pre-pandemic, and I mean, that's the lowest of any major kind of metropolitan area that Castle tracks.
So if you're not going to the office, you're not supporting all the local restaurants and whatever, and the tax receipts are not back to what they should be.
That and the commercial real estate values dip. That's
So the,
tough on the
the
city.
taxes, I guess, associated. So it's just this death loop, it feels like. But, you know, you talk to folks in San Francisco, it is getting better, they say. Like, but it's just, but as Nick was just saying, there's a lag, like a 1 or 2 year lag versus a lot of the other urban markets, but it is coming back. The traffic's starting to come back a little bit. I talked to my friends that own the Taddage Grill, the oldest restaurant in San Francisco, and they say their traffic's getting better and better, but it's still, you know, an issue. But I always tell people, like my friends, oh, I'm coming to the U.S., either the European buddies, I'm coming to the U.S. for 2 or 3 weeks with my family. Where do we go? And I'm like, yeah, do the L.A., the Vegas, all that kind of stuff. But you got to go to San Francisco. That whole Bay Area, I think, is top 5 in the country you got to see.
They have their problems for sure.
But the whole Bay Area, you can do the whole Napa thing, the Silicon Valley thing, go down to Carmel and San Francisco. I think it's all cool. So I'm a big fan of San Francisco. Freshman enrollment at U.S. colleges shows first drop since 2020. that's probably an issue for the municipal bond market because colleges use the municipal bond market to build stuff, don't they?
They do. We cover the small college space very closely. These are colleges, I think many Bloomberg readers probably know this is a really stressed space right now. There's fewer people going to college, there's fewer young people applying. And I think there's just questions about, is this degree worth $60,000 and what kind of job am I going to get when I get out? So this most recent fall enrollment data was really interesting to us. It showed the first decline in freshman enrollment since 2020, where there was a massive drop. I think the headcount dropped 10%, and they had been slowly recovering. And then this was a kind of, one of the authors of the report called it startling. So this is just a kind of another bump in the road for the higher ed sector.
How many of these small colleges have actually gone under? Quite a few, right?
Quite a few. This year alone, I think we're well over a dozen, maybe close to 2 dozen.
And those would be defaults in muni land, right?
Not all the small colleges have debt outstanding. It's somewhat expensive for a school to tap the muni capital markets, but a lot of them do. And obviously, you're defaulting as soon as you're missing an interest payment, and that comes usually much before you close.
So, some schools are selling some assets, right?
Yeah, it's been really interesting. We had a story out this week by my colleagues, Amanda and Lily, who looked at this trend of schools who tend to be rich in real estate and poor in cash, trying to shore up some liquidity by selling all kinds of things. One school they wrote about is trying to sell their kind of, their nicest building on their campus. Another one in Indiana, I think, had some Georgia O'Keeffe paintings that they sold. And sometimes these are just, run-of-the-mill trying to shore up liquidity. But for a school that's really facing some systemic challenges, selling real estate may be a Band-Aid, but it's not going to fix the problem that you have, maybe shrinking headcounts for years.
You guys specifically wrote about a small California art school. What school are we talking about here?
There's been a couple arts colleges. That was one. I didn't write the story, so I don't know exactly which school they were talking about. But another one,
the Cornish College of the Arts.
Oh, that's right.
There you go. How about that one?
I believe it was their Performing Arts Center, a really beautiful building on their campus that they're trying to sell, and it ignited some student protests. A lot of students said, this is one of the main reasons I applied here, and now I can't even go.
Yeah, it's tough. I tell you, having worked closely with Duke University and their board and their endowment, if you don't have a solid endowment, man, these schools are really at risk, John, because their business models just don't work. They don't. The tuition only covers about half of the expenses. So what do? You got to cut expenses, I think. But universities aren't going to do that.
Is it a case where anybody can get in now? It's just
a lot of them have become less selective. Some of these smaller schools, we've seen their yields drop. Getting a lot of applications and few of those students who get in actually coming. One kind of interesting little side note on the enrollment data we saw was that even though freshman headcounts dropped, overall undergrad enrollment rose by 3%, and that was driven by high school students who are doing dual enrollment and people who are going back to school, to finish their undergrad degree. So I think schools really have to focus on kind of non-traditional students as an opportunity to kind of diversify their revenue.
All right. Good stuff, as always. Nick Corello, don't be a stranger there. Municipal finance reporter for Bloomberg News, proud graduate of William & Mary University, the friendly rivals, I would say, of my University of Richmond, Spiders. How about that, John? You like our mascot, the Spiders?
The Spiders.
Here you go. I'm doing it.
Was it a poisonous spider?
I don't know. All right, John, one of the news stories today was a deal that's not going to happen. Tapestry's $8.5 billion deal for Capri. That's halted by a judge in a big win for the Federal Trade Commission. Not such a big win for the shareholders of Capri, I might add. Deb Aiken, she is our go-to person for everything luxury. Deb Aiken, Bloomberg Intelligence luxury goods analyst. Deb, I have to admit, I'm kind of surprised by this ruling by the judge. And I think the market is too, judging by the big decline in Capri shares. What's going on there with this deal?
I think so too. Hi. So, I would say there was a 60 to 70% swing of expectation of this deal going ahead, and it's all about the coming together. Tapestry's $8.5 billion bid for Capri could have brought together two very big brands in aspirational luxury, aspirational fashion, entry-level luxury, however you like to name, with Coach under Tapestry and Michael Kors under Capri. as well as their 4 other brands combined. And the idea, what was found by the judge is that actually there would be too much of an overlap and that there was a commission clash. So there's been a rule against the expectation when we looked at all the data sets, as well as many others who've done the due diligence, and there are reams and reams of data taken to court, where that actually there's so much fragmentation across the space, particularly in the US, which is the biggest market for both brands, across so many price points, online and offline, in department stores, in own stores, that this was seen as possibly a deal that could have gone ahead.
Yeah, it says, what were the regulators afraid of? Like handbag prices would, there'd be a monopoly and prices would go up, so I couldn't afford one?
Yeah, absolutely.
Who cares?
The expectation that over time price rises would be seen to be taking place in the industry once the 2 brands were together, and it was seen that they could have 59% of that aspirational marketplace, which I find difficult to understand, as does much of the market, given that we did a lot of work on that. And there is the deadline on this deal was actually the 10th of Feb. Speaking to one of our specialists last night, there's an understanding, of course, that Tapestry will appeal, that Capri will follow and go along with that appeal, but that actually to get the FTC to come up with their findings by the 10th of February would be difficult, and then an extension beyond which would be difficult. And at that point of the 10th of Feb, it could be that the deal would break up. So, there are still cogs in motion taking place, but the view in the market today is that Tapestry a little bit is safe, because the market versus when they put the offer in two years ago, coming up by the time it would complete, it was actually mid-2023. It's probably down for aspirational luxury in terms of growth. We're actually in slight decline. Difficult US market, very difficult China market, a particularly difficult Q2, and we haven't seen any change in Q3, and that's moved into October. For China, we're probably seeing that market down 25% plus after a difficult couple of years. And then for the US, very, very slow growth, and you really have to have your brand out there, visible, new design, new innovations. Coach is doing it well under Tapestry. We're looking at some data from Lyst to show that they're doing very well and their brand's eating up.
Yep.
But there is a long way to go.
All right. Deb, thanks so much for joining us, getting us up to date there. Deb Aiken, luxury goods analyst for Bloomberg Intelligence. John, I think I would just walk members of the Federal Trade Commission down like Canal Street. I mean, there's like 1 billion of these knockoff bags all over the place. I mean, you got to be kidding me.
I was tired of my belts that I bought at Kohl's falling apart after a couple of months. I'm like, I was going to step up, go to Coach. I was told by one of the retail experts, no, Massimo Dutta.
Oh.
And a lot cheaper, and so far, it hasn't fallen apart.
A little belt correspondent, John Tucker, very good. S&P 500 up 33 points at 0.6%. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow turning negative since our last update. The Dow in the red, Dow by 69 points, down by about 0.2%. S&P holding on to a 29-point gain, up 0.5%. NASDAQ up 217. That is an advance right now of 1.2%. Stocks, most stocks finishing the week on a positive note. The 10-year 4.20%, the 2-year 4.06%. Gold up $1.50 the ounce, little change there at $27.37, and West Texas Intermediate crude now up 2.3%, closing in on 72 once again, 71.80 for a barrel of WTI. Big tech leading gains ahead of next week's results. Lots of major names reporting next week, including Meta Platforms, Amazon, Apple, and Alphabet. Mixed data on the U.S. economy today, and with that story, here's Bloomberg's Vinny Del Giudice.
Lower interest rates are refueling consumer confidence and boosting plans to acquire big-ticket items like home appliances. The University of Michigan data also indicate Americans are more upbeat about the labor market. The U.S. presidential election less than 2 weeks away is a major influence. Sentiment among Republicans and independents rose to the highest since April, while confidence among Democrats edged lower. Vinny Del Giudice, Bloomberg Radio.
Apple shares cut to sell at KeyBank, which is questioning expectations for a broad rebound across Apple's businesses, saying they are unrealistic. Apple right now higher by 0.6%. And again, McDonald's shares are falling as CDC identifies more E. coli cases. McDonald's now down by 2.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pelleton, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube as well. So check us out there as well. Big take stories. We love them here. These are really, really deeply sourced stories. They go really deep dives into some really interesting topics. And this one's about kind of the wealthy and some of the advantages they have in terms of shielding their taxes. Justina Lee joins us here today, cross-asset markets reporter for Bloomberg News. She's based in London, joining us there via Zoom. Wealthy investors are using tax-aware long-short strategies to generate losses that can be used to offset capital gains taxes, allowing them to minimize their tax bills. I had not heard of this before, so I learned a lot reading this article. Justina, thanks for joining us here. Can you tell us what a tax-aware long-short strategy is?
Yeah, sure. I think most people probably, if you're familiar with the wealth management space, might have heard of tax loss harvesting. And that's where you sell your losing investments so that you have a capital loss to offset some of your capital gains tax bill. So tax-aware long-short essentially takes advantage of that same idea, except that because you have longs and shorts, it means that at any given time, even if the market is going up, you can still generate quite a lot of losses to offset kind of your capital gains tax bill. You know, maybe you want to sell your Apple stock, or you want to sell your house, or you want to sell your business. And so the whole idea here is it kind of gets you more losses faster.
When you don't necessarily have losses is the way I think I see this. Is that right?
Right, exactly. And it sounds kind of funny because obviously you want to make money overall, but the magic of these strategies is they're still trying to make you money on the whole, but usually kind of in a whole portfolio, even if the portfolio is making money, there will be some losing positions there because you're holding hundreds of stocks usually in these strategies. And so the idea is like, well, you know, you make the best out of those losing investments. And in the meantime, you're also like getting richer. And because you're saving money from not paying taxes, you can also be invested for longer.
So, and this is different from just regular tax loss selling, because I'm buying a huge basket of stocks knowing that overall I'll probably make money, but there will be individual losers, even if those are names I didn't necessarily want to own.
Right. So in regular tax loss harvesting, usually you just have a portfolio of stocks that you own. But the problem with that is that over time, the market goes up. And so you run out of losses to harvest. I mean, a lot of estimates say this can happen even just after a few years. And so with long shorts because you have those shorts that's betting against some stocks.
Gotcha.
The idea is you will always have some positions to sell.
Okay, so election day is coming up, and this does kind of sort of figure into the elections because the Biden administration has proposed taxing unrealized profits. How does this all? I'm not sure what Kamala Harris's position is, but how does this tie in?
Yeah, because I guess the whole reason tax loss harvesting works is that you, as the investor, you can choose when to sell your investments, and so most people, just never sell, especially because you can just pass them on to your kin, and then you get this the step up in basis as well. And so in order to tackle that, I mean, President Biden proposed in his budget earlier this year that he would impose a minimum tax on billionaires that would cover unrealized capital gains. And initially, Kamala Harris did say she supports that proposal in general, but more recently, I think her campaign has been kind of a little bit more vague about whether they would support, taxing unrealized gains in particular.
All right. So critics of, I guess they argue that these strategies, which are generally only accessible to the very wealthy, exacerbate wealth inequality and encourage complex tax avoidance schemes rather than encouraging investment and economic growth. How does the financial services industry respond to those critics? I mean, it's all legal, right?
Right, exactly. I mean, there are a few restrictions, like you cannot sell a security for the tax loss and then buy it back tomorrow. But yeah, I mean, generally, it's entirely legally above board. I think for a lot of critics, I mean, it just shows the problem with only taxing capital gains upon realization. But the problem is, and we've kind of seen this debate, unfolding over, Biden's proposal as well. The problem is if you're taxing unrealized gains, that's kind of very hard to administer, and also some people say it will discourage investments, and so that would be a massive overhaul, and I don't think anyone's expecting that to change anytime soon, and so I think that's also why these strategies have been booming.
Is the IRS going to swoop in at some point? Congress going to take hold of this and make changes? What's happening on that front?
There has been kind of a few bills in Congress over the years from Democrats to tax unrealized gains. And of course, you could say you could change kind of smaller things, such as ending the step up in basis or maybe changing the wash sale rule so that you can't, that's the rule that kind of restricts you from buying back the stock immediately after you sell it. But I think at the end of the day, I mean, a lot of, people I spoke to for the story say, I mean, they know that it takes a long time for these changes to go through Congress. So I think most people seem pretty confident that there won't be any material changes that will affect these strategies anytime soon.
Any sense of how many people actually employ these strategies?
It's hard to say, but it's interesting that they've actually been around for a few years now, but they've really only grown quite a bit in the last year or so. So AQR, which is sort of a pioneer here, I mean, their AUM in the strategy has almost doubled in just half a year. And like Quintino, which kind of shares some DNA with AQR, I mean, that's the only thing they do, and their AUM has more than doubled this year. This strategy does have a higher minimum threshold, so you do need to kind of put in at least $1 million. And of course, for this to be helpful at all, you need to have quite a lot of capital gain somewhere in your portfolio. So it's for the elite, yeah.
All right, Justina, thank you so much for this. A great story. Justina Lee, cross-asset markets reporter for Bloomberg News. Great big take story. You can read more of this story on the Bloomberg and at bloomberg.com/bigtake. Kind of makes sense to me. I don't know, but I guess that the regulators.
This is why I have an accountant.
Yes, exactly. I usually just get the phone call sometime in the fourth quarter. All right, Sweeney, we're dumping X, Y, and Z, taking the losses.
Not that I would qualify for any of this.
We're taking the losses.
Just saying.
On these losers to offset some gains somewhere else. S&P 500, we are up 32 points. The Dow is now negative. It's down 47 points, but the NASDAQ still up 1.2%. That's 226 points. Yields pretty steady here. 10-year Treasury, 4.21%. No real change there. WTI crude oil up 2% now, $71.67. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, we got Yanks. We got the Dodgers starting tonight. John Tucker, are you going to tune in?
What is it, 8 o'clock Eastern?
8:08.
Yeah.
Yeah.
I like to watch with a Chardonnay and Brie.
Okay, I'm sure. Yeah, you're the demo, I guess. Not. All right, Ira Boudway, business of sports reporter, Bloomberg News. He joins us here in our Bloomberg Interactive Broker Studio. You guys have a story out there. New York Yankees and LA Dodgers in World Series is a boon for Major League Baseball. Talk to us about the fact that they got New York, or maybe the two best-known franchises in the entire sport, the Yankees and the Dodgers, plus one's in LA and one's in New York. So from a TV perspective, this can't be any better, can it?
Yeah, this is perfect for the league, and you got the two biggest markets, the two most storied franchises, and you have the biggest stars in the game. You have Ohtani, you have Judge, and that's just the beginning of the list. So it's just as if they had scripted it to kind of help boost the mainstream appeal of the sport.
Fox paid how much initially to get the rights to do it, and have they broken even, or are they making money now?
So they extended a few years ago, I want to say in the range of $700 million a year for Fox's slice.
Yeah.
So, and that includes this year's World Series. And so this for them, I think, really helps with that return on investment. I think they're looking at the benchmark of 2016 when the Cubs broke their curse and drew like 22 million per game in a great series. That to me is, I think, what they would hope to maybe match this time around. So,
you know what's interesting about your story? It just kind of brought back the fact that the big spending teams are getting paid off for their big payrolls here. We finally, where in some years you got like Baltimore,
right,
and other small market teams that don't have a big payroll, they get to the World Series when the Yanks and then maybe the Dodgers and maybe the Red Sox and a couple others don't. But this year, it kind of reverted back to kind of what you thought it would be.
Yeah, I mean, last year we had a piece about how the correlation between payroll and wins kind of broke down, mainly because of the Mets with their historic flop. But you had these teams like Tampa Bay and Baltimore who were toward the bottom of the league in terms of pay, and they got into the playoffs while the Yankees and the Padres and the Mets did not. And so this year, you saw the two best teams in the league with the two of the three highest payrolls. And it was important, I think, that both of them didn't have to get through that first 3-game series. They just had the 5 and the 7, kind of take some of the chance out of it. And here they are. So I think it shows that like payroll spending matters. It doesn't determine everything, but it matters. And I think in both teams you can make the case that it gave them some wiggle room. You can have players who were injured or didn't pan out and still have depth when you have that kind of money.
There's the TV revenue and then the ticket sales, which I guess pales in comparison. But does that matter much?
Yeah, I mean, more to the teams. But, this playoff will help them cover a lot of that payroll spending.
And John's asking, he sees all these crazy StubHub prices for who's paying it? People are paying crazy prices for everything. I mean, and if you're in New York, it's a once in, I don't know how many years.
Yeah.
You're going to pay up.
Yeah, I mean, it's been a while
Crazy.
for the Yankees. They haven't won it since 2009, and these two teams haven't played since 1981. This is...
so like Brian Cashman's good for another 2 decades?
I don't know. Yeah, exactly. That's good. I asked Rich Drummond. Hey, I tell you what, I was looking in your reporting here. Japan and the Ohtani factor. I mean, Game 5 of the National League Division Series between the Dodgers and the Padres, which featured 2 Japanese-born starting pitchers, Yamamoto and San Diego's Yu Darvish, set a Major League viewership record in Japan.
12.9 million people watched it there, which was more than watched it here on Fox.
Is that right?
By about 5 million. I mean, Ohtani's celebrity over there is hard to, I think, understand unless you're seeing it. He has like his own section on the morning news. He is the biggest thing going. And so, and I think that, is a big deal for Major League Baseball. I mean, it's not like baseball wasn't already big in Japan, but I think this just gives them a chance to extend their footprint globally, especially in the Pacific Rim, and to reach new generations of fans.
Okay, speaking of new generation, I know young people leading up to this who could care less about baseball. That's a problem. Is that changing with this?
I think it gives them a chance. I think a player like Ohtani, who just has this sort of mainstream crossover appeal, is kind of like a Babe Ruth type figure, And I think a player like Judge and these two markets and the celebrity involved, I think it gives them a chance to reach younger fans again. We'll see how well they're able to leverage that on social media and things like that. But they've also been working hard to make the game shorter and more action-packed, and I think that can't hurt.
What about the time? I mean, 8 o'clock tonight on a Friday Eastern. Yeah, you could do that, but is if a game that goes to midnight on a weeknight, on a school night, that ain't gonna happen.
Sure, no, and this is an age-old complaint. When you're talking about 12-year-olds, it's really hard to optimize the viewing windows for everybody. But I think they're hoping that kids will be allowed to stay up late. I know my son will be asking.
Well, I think social media. I mean, a lot of these sports have become very savvy on social media, and that's how they reach a lot of the younger demos, particularly in National League football. I mean, the kids don't watch a game start to finish, but they watch the red zone or all that kind of stuff, and they consume it all on their social media platforms. So if you're ESPN,
what's your betting? Who's going to win?
Who's going to win?
In 7.
I do think it will go 6 or 7, and I'm going to pick the Dodgers.
I'm officially. I did this on surveillance this morning, John. Yankees in 7 was my pick. How about you?
Yeah, I'll go along with you.
Yeah.
What did Johnny Damon say? He agreed 7.
Yes, he did. Yes, he did.
Of course.
But I was first on that one. But we'll see. It'll be good. And again, the winners, the Yanks, the Dodgers, no matter what. Major League Baseball, no matter what, and the Fox Broadcasting Network, no matter what. So that's good news there. Ira Boudway, thanks so much for joining us. Ira Boudway's got a great story out there on the Bloomberg Terminal. You can check it out on Bloomberg.com. Coming up, we got Balance of Power with Joe Matthew. I think he set up a cot, basically, just in the newsroom. He's going nowhere between now and Election Day, maybe even a couple days after that. So Balance of Power, Joe Matthew, Washington, D.C. That starts right now.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
11 days. Welcome to the fastest show in politics as the candidates head for the Lone Star State today with another major poll just out underscoring how close this race is and how no one knows who is going to win. We'll be joined this hour by Bloomberg political editor Laura Davison with us in Washington, and we'll dive into the early vote with an expert. Sam Almy monitors ballots in Arizona and will bring us inside in a special conversation you're only going to hear on Bloomberg. They're pulling out the big guns this weekend. It's Beyonce versus Elon. We'll have analysis from our signature panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis along the way. They're with us for the hour, and we start, as always, by setting the baseline on Wall Street with our friend Charlie Pellet. He's at World Headquarters in New York. Hey, Charlie.
Well, I thank you very much, Joe Matthew. What a week, and we seem to say that every week, but here's what's going on in terms of U.S. markets. We have got the Dow trading lower, declined in the past hour, down 92 right now, drop there of 0.2%. S&P, though, holding on to a 27-point gain. The S&P 500 index up now by about 0.5%. The Nasdaq Composite Index up 206. That is a gain of 1.1%. Your 10-year 4.21% with a 2-year 4.06%. Spot gold up $1.30 the ounce to $27.37, up less than 0.1%. And West Texas Intermediate crude oil trading higher now by 1.9%, $71.49 for a barrel of WTI. Bottom line here, stocks finishing the week on a positive note after a strong reading this morning on consumer sentiment. Big tech leading gains ahead of next week's earnings. As for the election outcome and potentially what we could see for markets in 2025 and beyond, John Stoltzfus is chief investment strategist at Oppenheimer.
Once you're beyond Inauguration Day, you've got a year that's almost, there's some kind of a honeymoon that usually happens. Think back to 2017 and then think back to 2021, were honeymoon years for the president who just been inaugurated. But then in the year that follows the inauguration is when the rubber meets the road and you get an idea what the policy changes actually are.
John Stoltzfus of Oppenheimer and Company. We're keeping an eye on McDonald's. The CDC says the outbreak of E. coli linked to McDonald's burgers has now infected 75 people in 13 states. That's up from 10 states and 49 on Tuesday. McDonald's shares down 2.2%. Briefly, the deal that isn't happening, Capri Holdings plunging after a federal judge blocked the planned $8.5 billion acquisition by Tapestry, the maker of Coach and Kate Spade handbags of rival Capri. Capri is plunging 47%. Tapestry up now by 14.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. Balance of Power continues. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet. I can tell Charlie's excited for a little Willie Nelson and Beyonce later. Welcome to the Friday edition of Balance of Power. You made it to the threshold of the weekend, and this ought to be a fun one if you care about this stuff. Maybe you're getting turned off by the celebrity, but we've got a big Joe Rogan interview, the podcast today. Donald Trump is in Texas, in Austin, for that recording. I suspect a few people will hear it. And he's going there because, well, Kamala Harris was already planning to be in Texas. She's in Houston. Yes, with Beyonce and Willie Nelson, a big rally there planned for tonight as she tries to seize on the issue of reproductive rights, abortion, of course, noting Texas's abortion ban. That's the backdrop for her. And we're going to go cascading into a weekend of showbiz and celebrity that will culminate on stage at Madison Square Garden, where Donald Trump has rented out the room for $1 million. And I'm deeply curious to see who shows up, because this is a big battle of the celebrities, right? Thanks for joining us on Bloomberg Radio, on the satellite, and on YouTube, where you can find us right now by searching Bloomberg Business News Live. This is right around the time when the national anxiety reaches a fever pitch. People are starting to turn off newscasts, turning away from the doom scroll, even though I know you're looking when we're not watching. Because we have another poll today that says what we already told you yesterday and what you're probably feeling, and that's why the anxiety exists. It's a tie. Yesterday, Bloomberg swing state poll, remember 49-49 in the 7 swing states. Not just like a statistical tie, a real tie. And today, it's the New York Times Siena College. Remember, we've talked to Don Levy a lot around here. 48-48 in their poll. So we do have some consistency, which is pretty interesting. I want to bring in Laura Davison at this moment because she is feeling the collective anxiety every day. This is what she does. Bloomberg politics editor with 11 days to go. How you holding up?
You know, we're going to be in there. We're almost down to single digits.
You are.
And, you know, it is tighter than ever, which I think just adds to the fun.
That's right. Tighter than a tube sock, as Dan Rather would have said. Interesting to see another poll like this, right? We were just talking about the Bloomberg Morning Consult poll yesterday. To see an entirely different organization with a presumably different sample to come to essentially the same result tells you what?
It tells us that this is a really, really close race. And sort of what we saw over the past, you know, kind of August, September time period where Harris was kind of steadily gaining, that has really tightened off as a lot of people, you know, those undecideds have, you know, finally tuned in and said, look, I'm either going to, you know, land on Harris's side, land on Trump's side, and that there's just this teeny tiny sliver of people in the middle who are still undecided. And that's why you see the star power, the Beyonce, the Joe Rogan, you know, the candidates are going out trying to reach to people who, you know, do not want to listen to political news regularly.
God love him. Before we get into the star power, does this Rogan interview, I mean, he was saying nice things about RFK Jr. Does it end up being an endorsement? Do we know? Is this going to be a challenging interview? What are you expecting to come from this?
You know, this will be it'll be a long interview. That's what Rogan does. You know, we could have, you know, 2 or 3 hours of, you know, Trump with Rogan sitting down. You know, Rogan did endorse RFK Jr. He, you know, sort of said he supported him.
That's right, yeah.
And then he also said some nice things about Harris. After that debate, he said that, you know, Harris, you know, was very polished, that she was well prepped, and that Trump was flailing a little bit. You know, that was, remember the debate about Springfield and eating the cats and dogs. Rogan in the past has espoused a lot of the same ideas that Trump has. This is very much a podcast that is geared towards young men, people who are very online, dabbling in conspiracy theory. So this is sort of a key audience for Trump.
Big time,
But I don't think he needs necessarily the explicit endorsement. He doesn't need Joe Rogan to say the words "I endorse you." Just having him on the show and having what will probably be a relatively friendly conversation is enough to get Trump what he needs.
Does something wacky happen? Does Rogan light a joint in this interview the way he did with Elon Musk? Does Elon Musk show up with him? It's in Austin, right? Did they roll in there together, maybe?
Highly possible, though. Elon Musk is spending a lot of time in Pennsylvania these days doing get out the vote efforts. But expect that there will be all sorts of pageantry, all sorts of fun surprises.
We're
this
here
is
for the pageantry.
because it's not really news. This is entertainment. So
well, thank you.